we're still waiting.
YouTube goofed. I hit the go live button and it froze the screen. Okay,
But
I think
yeah.
we're live now. Okay, we are live now. All right, sorry, guys. Welcome to the stream. We'll cover everything that we just talked about. Sorry, Chef, I'm gonna have to make you
No
repeat
worries.
yourself. Welcome, everybody. My name is True Demon, and I'm the Devil Stockbroker. This is going to be the stream for the market today. We're going to cover everything starting from right now until market close, and maybe just a little bit after. We got several things happening in the news, starting with AMC and the $1 billion infusion from Amazon, which is promising to dump $1 billion into its movie investments, probably for Amazon Prime films. But the expectation is that these will be shown in cinema. The other catalyst that we've got today is the FOMC minutes release, which is going to be occurring at 2 p.m. Eastern Standard Time today. That is going to be coming in the next hour and 10 minutes. And we expect the market to get really volatile as soon as that happens. We're going to quickly but carefully analyze those notes, and we're going to cover exactly what market expectations are going into this, and we will let everybody know what to expect going forward once we analyze those notes. Besides that, we had Cosmos Holdings, which was a really nice play for us. This is what we were just talking about, so sorry for everybody who missed the stream, or, well, YouTube kind of goofed on us, but Hell's Trading Floor became aware of Cosm after it had created this bull flag and then broke down on a double top, forming a floor just at its 50-period EMA, and then breaking that 200-period EMA on the hourly candlestick chart. And at this point, Hell's Trading Floor got a confirmed buy signal. We entered in this range down between 12 cents and 16 cents. And from that low point up to the high, a full 400% measured move, where Cosm had hit a high of 66 cents on the dot. So Chef was the one who started playing this one the earliest. So Chef, go ahead. Sorry that we weren't live for your explanation before, but tell us all about Cosmos.
Well, I was alerted to Cosmos by Hell's Trading Floor's very own Savvy Trading. And I looked at it and I liked the setup and got in at 8 cents and it popped up a little bit, got out at 12, and then I saw that there was something a little more. So I started digging a little bit, and then I got back in at 16 cents. Found out there's a lot of short exempts there. Scourge Bot, our proprietary bot of Hell's Trading Floor, of course, alerted me to the fact that the short exempts were just crazy. And throughout these movements, even the past few days, the short volume, not the short exempt volume died out a little bit yesterday, but the short volume is still where it is. And I started doing a little digging and I found this news bit from a month ago, and it's Cosmos Health and Smart for Life execute letter of intent for strategic global co-venture. Now, this was put out on October 27th. And interestingly enough, they said that they were going to make the announcement in about a month's time. Looking at the calendar over there, it's November 23rd. It's coming up on a month. That might be coming up. And when I'm looking at this chart, I got stopped out at 45 cents, by the way, for my 16 cents. But I'm looking, and it's stuck between the Fibonacci levels right now, this last movement of 61 and 50% retracement. So I think it's making a base. I don't think it's done. I think this news may possibly be pretty bullish, or maybe that's what this movement is. It could possibly be somebody already knew that it's going through, and that's why the jump. I don't know. That's what I know.
That'd be pretty wild. So this one is still setting up some support here at the 10-period EMA. So that's actually a really nice setup. If you follow it down on the 5-minute charts, you'll see that it's been establishing support each time reliably at the 50-period and just now the 100-period moving average. But this one's been floating upward ever since the 17th of November, and it's been continuously setting up these higher lows. The lowest that it ever seems to really touch is the 200 period EMA after those big retracements. And then once it hits its second bounce off of the 200 EMA, that's when it really starts to get moving along. And we noticed that after 1, 2, 3 bounces off of the 100 or the 50 EMA, it kind of undercuts the 50 EMA. But that bounce off of the 200, followed by 2 bounces off the 100 EMA on the 5-minute chart, usually signals a pretty powerful move to the upside, from which point we can track based on a trend extension.
By the way, today is National Fibonacci Day, so we should be making fibs on every chart. Every single chart should have a Fibonacci retracement.
Is that a fact? All right. All right, so if I go ahead and move up to the move the trend extension up so that our Fibonacci trend extension from low to high, with the high set up here on this second top, we see that Cosmos gets its first retracement down to its 50 level, bounces up to the 78, retraces, and then has to break through the 61% fib retracement level. 1, 2, 3, 4, 5 times it took it in order to actually break this level cleanly and then continue to the upside. So now that it's gone so far so quickly, we're going to have to kind of sit back and watch this one. But the news or the expected news that Chef described could be extremely bullish for this ticker. So we're going to keep a close eye on this one. It did just bounce off of its 100 period moving average. We need to see it set up some more support down here. If it is able to set up a floor above its 50 period EMA, then I would consider that continuation signal. We do have a bullish cross up on the MACD. It is not outside of the price clouds, so this one can still drift a bit further down. But this first top is looking pretty far away from us, and since we are well below the 50 level, my fib retracement go. So this would be a bounce off of the 61 retracement level. So if we can hold this support right here, I would consider that to be a very bullish signal. We just got to wait this one out and see if it's able to hold the 62 and the 50. Let's go and move over to AMC, and let's actually talk about some of the news that we were just reading about AMC. So for those of you who are not aware, AMC just got a bullish catalyst thanks to Amazon promising a $1 billion plus investment in theatrical releases. So this article comes from Seeking Alpha, which I'll read off to you right here. Cinema stocks jumped just before midday Wednesday alongside a report that Amazon.com plans to spend $1 billion plus annually to make movies it will release in theaters. AMC spiked 6.2%, Cinemark 7.5%, IMAX 7.1%, National Cinemedia 5.5%, Cineplex 2.2% in Toronto. Amazon plans to make 12 to 15 movies for theatrical release each year, Bloomberg reports, starting with a smaller number in 2023 and building that output over time. Such ambitions put it squarely into the lower end of the realm of major Hollywood studios. Amazon spent $8.5 billion to acquire mini, major, and longtime studio MGM, the home of franchises including Rocky and James Bond. It would also mark a divergence from the strategy of a key streaming rival, Netflix. Netflix rankled the cinema industry by flooding the zone with a streaming movie per week approach, and when it does put its films in theaters, as with the new Glass Onion: A Knives Out story, it's doing so for just a week before putting the film on stream. Amazon hasn't quite put as much into original film production as of late, but the new report suggests a heavy ramp up there as well as a friendlier relationship with the cinema industry. Just 2 days after winning deal approval in Europe, Amazon closed its $8.5 billion purchase of MGM in March, acquiring an iconic name with more than 4,000 film titles and 17,000 TV episodes in its second biggest acquisition ever. So this is a tremendous catalyst for AMC because it doesn't mean a direct investment in AMC, but rather that there will be more movie content. And since Amazon has a lot of weight behind it, Amazon is capable of putting out some really good hit piece films and series, which AMC is promised to show far more frequently in its theaters. So the big pull for AMC is that its business is dependent on new studios putting out new cinema every single year, and Amazon's promise to put out a new film with between 12 and 15 releases every year or more. That adds a huge itinerary of cinemas for AMC to show in its luxury theaters. So this is actually quite a big deal since AMC has been showing record profit on some of the smallest films and the most budget films that have been released over the last several years. There have been some exceptions, such as Spider-Man's No Way Home, or man, I haven't been to the movies in a while. I'm trying to think of something that I've seen recently. But in any case, AMC has been looking for bigger, better films to show in its theaters, and honestly, the pickings have been pretty slim. The Marvel comic book hero series films tend to do pretty well, but they've been in decline. They've been waning in popularity lately. So AMC needs something new in order to bring people to the box office. Looks like the details from Benzinger are a little bit thin, so the meat of the article from Seeking Alpha pretty much tells us everything that we need to know. Let's go ahead and jump back over to the charts and see what AMC's been doing lately. So I'm over here on the 1 hour chart, and I had noticed that AMC had set up a two-touch bottom here in its chart since October the 13th, and another bottom right on its earnings Wednesday, November the 9th. So this two-touch bottom, while would traditionally break a double bottom, also came in line with a bottom from AMC's pre-squeeze moves back in April of 2021. So I had been watching this level of support to see if AMC would hold it, and as it turned out, it did. Even though we had a bear flag that had been developing over here on the right-hand side of your chart, this bear flag from AMC promised to take AMC all the way back down to $2 if the technicals played out fully. But instead, what we got was a bounce right off of a strong level of support at $5.25. And AMC has now formed a bull flag and is starting to develop what looks like an inverse head and shoulders. So you can see the first shoulder forming here, the head here, and now it looks like we're about to form another shoulder with an ascending line of support and an ascending neckline right here. So now for AMC to start continuing on its trajectory to the upside, we want to see AMC begin to challenge its 100 period daily EMA. That's this orange trend line that you see here on the charts in front of you. So for AMC to break out of this level, we need to actually see a candlestick break, close above, and hold this level on a daily candle. We did get one touch outside and a second touch right at this 100 period EMA, but what we really need is a closing green candle above. It's going to be critical for AMC to close above around $8.10, which is going to be a little bit difficult because there's a lot of options that are expiring in AMC every single week. Market makers are really keen to hold it down and keep collecting that premium off of AMC every single week. One thing that I have been a big proponent of, especially for options traders who are trading meme stocks, is that the real way to make money is never with weekly premium, but rather with purchasing in the money leaps. The thing with leaps is that while they are expensive, they lower your delta, or not delta. Sorry guys, I'm having a brain fart. I have to drink a little bit more coffee. It lowers your break even. That's the word I was looking for. So by purchasing an in the money leap on any of these particular stocks, especially since you don't know when a squeeze will take place, but you can be pretty sure that there will be profit-taking opportunities while the market is having its occasional bull rally. If AMC is trading at these lows and hasn't broken them in a long time, then what you can do is you can purchase in the money leap options with a lower break even. And when I say in the money, I mean below its current market price. And by a leap, I mean an option that expires more than a year from now. You can go with something that's a little bit cheaper with like quarterly or semi-annual expirations. That's 3 and 6 months respectively. But the way that I see AMC playing out is that we don't actually know how much capital is holding down the stock. And in between those times when AMC is fluctuating around, jumping up and down, and then getting hammered on Fridays and pushed to the downside just so that they can expire those weekly options, that's just a lot of retailers handing over cash over to market makers, which they use to further push down and put selling pressure on the stock later. So the more money that you hand them, the more ammo you're giving them. When you purchase an in-the-money leap, what you're actually doing is you are ensuring that in order for the market maker to have the stock available for them to cover those contracts in case they get exercised, they must purchase the shares in order to hold them. This is an activity known as delta hedging. That's because when a market maker sells a covered call or a naked call, in order to make sure that they have the ability to cover that stock if the call is exercised by the buyer, then the market maker needs to go into the market and purchase them, or at least have them on hand in inventory. And when you purchase an in-the-money leap, that automatically means that the market maker needs to have that option available. They need to have those shares available, in order to delta hedge their risk. Because ultimately, the market maker's goal is to remain break even. So if the market maker is naked, selling naked calls, that means selling a call without holding the underlying security, then they are taking additional risk onto their books. If what ends up happening is AMC goes through a period of volatility and say it jumps up to $9.50, and you have a whole bunch of retailers that have purchased in the money call options below $7, then these are now $2 in the money. And if that happens, then those options buyers can technically exercise their calls. If that happens in mass, then the market maker is forced to purchase shares because they didn't purchase them ahead of time in order to make sure that they were covered. They were covered on their delta risk. So then, once the price is already up at $9.50, then the market maker has to purchase more of them, and that lifts the price up to $10, and that makes it even more expensive. And when that happens, then you have all of those options that start going in the money. And then you can have this runaway effect that's known as a gamma squeeze. So just to illustrate exactly what I'm talking about, I'm going to put up on the screen a quick look at a gamma ramp chart so that you can see for yourselves what effect this can have. So if you'll look down here, we have on the left-hand side the percentage of float in the money. Currently, AMC's got around 1.6% of its float in the money on the call chain. And that's based on its current strike price of around $7.50. So at $7.50, around 1.6% of AMC's total outstanding float is, quote, in the money. And if everybody exercised their calls right now, then those call buyers would combined own 1.6% of AMC. Now, if AMC jumps up to $10, suddenly the percentage of that float goes up. And that jumps all the way up to, we'll go ahead and round it out to around, we'll say 5.5% of the float. Okay? So 5.5% of the float in the money if the stock goes up to $10 strike. So if everybody at $10 strike or below exercise all of their calls, then they would combined own 5.5% of AMC's total stock. That's what causes gamma squeezes. Because if the market makers didn't purchase enough shares to cover these calls and they all were to get exercised, then that would result in the market maker being forced to buy more, which can cause the price to go further up to, say, $15, at which 8.2% of the stock would be owned by the call buyers. So this is the kind of effect that happens, and this is why we refer to this as a gamma ramp, because it ramps up the price and the percentage of the float that goes in the money. Now, this isn't the most extreme gamma ramp that we've seen. Normally, for a stock like AMC, which I would consider a mid-cap stock, I would love to see more than 15% of its float on the call chain, with the potential for a short-term price run resulting in more than 15% of the stock being transferred into the hands of retail investors who purchase call options. That would be my ideal scenario. 15% or more tends to result in a pretty good amount of volatility and momentum to the upside. So right now, AMC doesn't have quite the amount of shares available, at least not until December 30th, but there are plenty more options expiring in the distance. So I'll go ahead and pull up another chart. Hey, Persephone, I think that you may need to adjust your YouTube quality. Sometimes the stream will downgrade you to a lower quality, and you won't be able to see it as clearly, so it makes your screen blurry. If anybody's experiencing blurry screen, just check your video quality settings and adjust it to like 720p or higher. So here's the other table that I'm going to show you. This is AMC's live call open interest percentage of the float. Over here we have the strike prices. Down here we have the expirations. And then the heat map shows you the percentage of the float in the money for just the particular strike that we're discussing. So if you look down here, these are all of the options, all the call options that are expiring this Friday, November 25th. So for 750 strike and above, we have a huge amount of calls that can run in the money. If a whole bunch of these end up in the money, then in total, we would have roughly, I would say about 3, maybe 3.5% of the total stock transferring over into the hands of retail investors who purchase these calls, or whoever purchased the calls, as long as they got exercised. Now, if market makers sold these without actually purchasing stock to cover their delta risk, then if all of these call holders started exercising their calls, then this would actually force the price to go up because market makers would need to purchase the shares in order to deliver them. And they only get 2 days to do it. Late settlement is extremely bad for market makers. Now, they can delay things and they can put it off for a while, but when this happens in mass, in large enough numbers, this is what causes the gamma ramps. And this is an example of a gamma ramp. It's a pretty small one, but it is a gamma ramp. And you can see on December 16th, we have a lot of these building up as well. All the way up to $15, which is just $15 expiring December 16th is 0.5% of the total float for AMC. And when you add all of these together, it adds up to around 1.5% of AMC's float in total. So if you were to add all these calls that would be in the money below $15, that's a huge chunk of AMC's float. And you can also notice that further out expirations, there's a big focus around the $10 strike as well, such as June 16th, $10 strikes, that's 0.6% of AMC's float, with over 31,000 open contracts on AMC. So these are things to look at and analyze in order to determine stocks that have gamma ramp potential, gamma squeeze potential. And if you want to get this chart, you can get this at Hell's Trading Floor. Our Demon members, which is the 3rd tier membership for Hell's Trading Floor, those members have access to all of these charts, which you can call up on any ticker in the stock market on demand whenever you want. Let's go back to the charts and go see what AMC is doing here on the 5-minute. Right now, AMC looks like it's forming up a really nice bull pennant with a ascending triangle shape. We've got this level of resistance up here that AMC's already tried to break once, The danger here is that we may be forming a head and shoulders pattern. So if we do not hold up this support and end up drifting down and forming another shoulder, then we may see AMC get pushed back down to around $7.20 would be the next support line. So hopefully that's not what we're in for. We're hoping to see AMC hold this support right here. I'm going to go ahead and remove some of these other chart lines just to clean things up a little bit. Also, I want to throw a big shout out to Savvy Trading for going out and finding that news article from Seeking Alpha, and I think he actually posted one from Reuters. Their coverage on Amazon's $1 billion investment into movies was that was big, that was huge. So shout out to Savvy Trading for finding that for us. Hey Vendetta, thanks very much. I appreciate that. Let me catch up with the rest of chat. If you guys have any requests or anything that you want me to take a look at, or if you have any questions on any of the information that I just shared, feel free to throw it into the YouTube chat. That's where I'm currently looking right now. You guys let me know if there's anything that you need to know. In the meanwhile, let's go ahead and take a look at SPY. I don't see any requests so far. Thanks, General Disarray. Yeah, if you guys are just joining the stream and you're enjoying the content, the information, the education, I'd really appreciate it if you would just hit that like button. It really helps out the YouTube algorithm and attracts more people to this video. It shows up in more feeds. We can get more people this information. Take a look at the SPY? Absolutely. We'll go take a look at the SPY. So right now, SPY is starting to show what looks like it could be a double top formation on the daily chart, which is why I'm really cautious with us going into this FOMC notes release. Everybody's expecting the Fed to really get kind of, shall we say, lenient with us, but I'm not so sure. The SPY has been showing signs of weakness recently, and if these notes are not what everybody expects, then we might get some pretty strong pullback, and that's what I'm most worried about. Especially since Black Friday is typically a very bullish week, and we do have seasonality working in our favor, so that's also worth paying attention to. I'm going to actually go out and seek out the seasonality chart while we go and drop to the 5-minute on SPY and just do a little bit of analysis here. Let me go see if I can find this really quickly. Let's get the seasonality chart for the S&P 500. This is it. This is what I want. Okay, so this is the seasonality chart that comes from Almanac Trader. What this is showing, and I do apologize, the picture is a little bit blurry. It's low resolution. There's nothing I can really do about that. But if you can't read this, in the black line, you have all years stock market average performance. Blue is all midterm election year stock market performance. Green is first term midterm years. Purple is Democratic presidential midterm years. And red is second year new Democratic president midterms. So all of these charts are matching the exact conditions of our current year that we're in, 2022. Okay? So what we should be paying attention to is that at the end of October, we got this big pullback, which if you look on the chart on the SPY, We'll go back to the daily chart really quickly. September and October were bearish. We got our big pullbacks in October and September both. So this matched up with seasonality perfectly, okay? End of October into November, we got a big push to the upside. This also kind of agrees with seasonality. We actually normally would see more pullback going into the very end of October and then see on the last week of October a big push to the upside going into the first week of November. We did end up seeing that pullback a little bit late. So the pullback actually occurred right on the first week of November, and then we got the push that we normally see seasonally speaking. So now we're going into the very end of November. What do we normally see then? Well, normally from mid-November until the very end, we see a little bit of pullback right before we go into the seasonal rally. So the seasonal rally tends to happen right around Black Friday, third and fourth week of November, especially the fourth week of November, and then we go into a seasonal rally through December. What's different about our market right now is that we are trading in a bear market, which is not something that typically happens for these midterm election years. It's not the average performance. The other thing that we have to worry about is that we are in an inflation environment. So inflation environments are very different and they're not common, so there's not a lot of history on their performance. If we wanted to go and look at how the market performed during a inflationary period, we would have to go all the way back to the 1970s and 1980s in order to see any comparison of performance, which is going to be a little bit difficult. I'll go and drop down to a weekly chart and we'll go take a look at some of these. I got to go to the SPX because it doesn't actually show up on the SPY. All right, I'm going to try this one more time. So in order to actually look at what this is like, and I'm going to go ahead and put USIR year. That's U.S. inflation rate year over year. And the peak inflation period for the market was right here when the inflation rate had jumped up by 180% year over year. The inflation at the time would have been somewhere around, it was around 18% core inflation rate. So it was pretty extreme. So this is the period that we should be looking at in order to determine what seasonal markets look like. I'm going to go ahead and take away year over year. And just looking here at October, November, we did see the big pullback at the end of October here in 1978. And then right in November through December, we did get that big push. So that is consistent with our seasonality. Let's go to the next year, 1979. October, we got a big pullback going into the last week of October, and then all throughout November, December, we got a huge push to the upside. It seems like at the very end of December here, the entire market bull flagged and then pushed to the upside. But what you'll notice here is that in neither of these conditions, in neither of these markets, are we in a bear market. Overall, the market is trading above its 200 weekly moving average. So these markets are consistently bull markets. None of these inflationary environments are bear markets except for this one, 1977 through 1978. And this is when inflation was truly getting out of control. So in this condition, September, October, we had the pullback and then a big pop in November. And then right at the beginning of December, the entire market dumped all the way into next spring. So this is the one that matches our conditions, where we had a bear market begin in January of 1977, and it moved down consistently, creating lower highs, lower lows, and creating new floors. And December, the very first week of December, is where the weekly tweezer topped, and we saw a rejection off of its 200 period weekly EMA. The market dumped from that point until it finally hit its final low in spring of 1978. So this is a very different condition from what we're currently experiencing. Right now, the market's pushing up and everybody's really excited with FOMC. But, well, this is unfortunately right around the time that Paul Volcker took over the Fed back in the 70s. And if I go ahead and put U.S. inflation up here, you can see that inflation started to go nuts again. Let me go put the funds rate. The effective federal funds rate at that time. This is when Paul Volcker just took over and started raising the rates at incredible rates. And that's what finally brought inflation under control. When the effective federal funds rate was around 17%, which is record high. Yeah, right at that moment was when it finally peaked. And then they brought it up to 19% the year after in the fall of the 1980s. And that's when inflation finally came down, and the market did pull back pretty strongly from that point again. So it's tough to say. We have to pay real close attention to what's going to happen at this Fed meeting, or not the Fed meeting, but the FOMC minute notes release. So when the notes get released, expect the market to get really volatile really quickly. Things are probably going to be a little crazy for a while. We're going to try to get our hands on the notes and analyze them quickly and carefully so that we can get a good idea of what they actually say and what they actually mean and what we can expect the market to do and behave like following that. Because all those notes are going to tell us is what's the Fed's mood about whether we're going to have to raise rates by 75 basis points or are we going to pause in December. Everybody is really hoping for a pause, and that's kind of what the market's pricing in right now. So I'm really, really hesitant to believe that the market is going to keep going up if the Fed hints at all that it's going to continue on a 75-point rate hike. Okay, I'm going to go ahead and check over some of these other ticker requests while we've got some time. We've got Tesla. So Tesla really popped really strong. This was an unexpected move. I was anticipating Tesla continuing to reject off of its 50 EMA, but the market bid it up very quickly. We're now getting a cross down on MACD, but it's not pulled back as far as I would have expected for it to demonstrate weakness. This actually looks pretty strong to me. So Tesla is setting up a bull flag, and I guess as they say, that's what happens when you bet against Tesla. But we got to watch this one really closely. If Tesla breaks its 200 period 15-minute average, then I would expect it to continue to the upside. I'm also noticing that it seems like it's getting ready to form an inverse head and shoulders a little bit. You might also just take a look at this and say, oh, this is a cup and handle. And it is kind of looking that way. So Tesla's actually looking pretty strong, but it's really, really, really going to depend on FOMC. If FOMC minute release show hawkishness, then the market's going to get rug pulled really quickly. So I'll be carefully watching that and seeing how the notes affect the market before making any decision. Saw somebody requesting Facebook, so we'll take a look at Meta. Meta Platforms is also starting to base on its 200 period 15-minute moving average. This is the 200 EMA in the red right here. So we got a bounce right here. We had it undercut and then bounce with a V-shaped recovery, and now it's bounced off of it again. So this to me looks like an inverse head and shoulders. Very, very clear inverse head and shoulders. And here's your neckline. So as soon as Meta breaks this 112.50 level, then that's pretty much the signal of a bull run. Looks like 112.75 is actually the price to beat. So if Meta does end up bouncing at this level, creating a V-shaped recovery and breaks this high, it needs to close a 15-minute candle above this level in order to confirm the move. But this does look pretty strong from a technical perspective, at least. Fundamentally, I'm not so sure about Meta. They've been sinking a lot of money into their metaverse platforms, and it's not being very well received. They did just go through a big round of layoffs, which was what this entire gap was all about. And it does appear like it's attempting to fill this gap. So, yeah, it tried to fill the gap at first, and it kind of gave up once it hit the 120 level. But if Meta breaks this neckline and starts moving up to the upside up here, then I expect it to continue on and fill the rest of this gap all the way to 130. So that's actually a really good trade. If you can get some calls that take you out till the end of December, then that could be a good trade to catch this holiday rally for Meta. Amazon puts for $91 ending in Friday. Let's take a look. So Amazon is looking, well, it's actually looking pretty weak because this bear flag that it's forming here is taking it below its 15-minute 200 period moving average. Hold on, I just got an alert. Okay, it was just an email. We're good. Sorry for the scare, gentlemen. So Amazon looks like it just got rejected off of its 15-minute period moving average, and that is a pretty bearish setup. So with this drop here, and it bounced 1, 2, and it looks like 3 times off of the bottom of this bear flag. If Amazon doesn't catch itself here, then it can drop. I don't know about $90 for Friday, but if you see it break this level, then I would probably go $90 for like 2nd or 9th of December. I could see that. I could see that playing out. But giving yourself only 2 days for that move to complete, I think that would be asking a lot from the market. This took an entire week for this move to play out, and even if you only got the 20% move that you need, but this is not 20%. Geez, what am I talking about? You would need about a 2% drop in the stock in order for it to actually get there. I did get a meeting alert. Hey guys, I got a meeting with my boss that he's surprising me with, so I'm going to have to pause this right here. I'm going to hand over control of this over to Chef Pew Pew and Mr. Boulay. If you guys wouldn't mind just going ahead and talking folks through the market, I'll go ahead and leave the SPY up, and you guys can go ahead and carry this on while I go meet with my boss, and I'll be back in 15 to 30 minutes. Sorry for the interruption, guys. I'll see you guys soon. Hey guys, I just realized that it doesn't look like Pew Pew or Boule are here on the stream, so I'm just going to go into standby mode. So I apologize for that. I'm just going to leave the stream up on standby. We will resume this, but I can't leave my boss hanging. So I'm going to leave a standby up, and we'll come back here in a short while. Hey guys, we are back. Sorry about the lengthy delay. Let's go ahead and get the FOMC minute notes ready. Hopefully I can go figure out where this link is at. Got to get this all set up. Yep, sorry about that, guys. There's nothing I could really do. It's just kind of sprung on me at the last minute. Good afternoon to everybody in the Discord and in YouTube land. Let me go find YouTube. Or not the YouTube, the FOMC notes.
Welcome back, boss man.
Hey, Chef. Ain't that just the way it goes? That as soon as you have 3 minutes to take care of something, then all of a sudden an emergency will come up?
Every time.
Every time. Okay, so the minutes of the Federal Open Market Committee. Okay, so we're going to go over to the press releases on Federal FOMC. We'll put the SPY up here. And there we go. All right, so SPY is so far looking okay, still holding up its support on the 100 period EMA. Does look like it may be setting up an inverse head and shoulders. We're not sure yet. RSI is looking like it's getting a little weak though, and we did have a bearish divergence right here from this high. Right there. Okay. All right, so for those of you who are in the Discord, if you're listening on YouTube right now, if you want to get my voice live through the Discord, you can join in the live stream film studio channel up in the stream section. I have the Fed FOMC press releases page up. I just kind of have to set up a refresh on this one. I'm actually going to set up an RSS feed. And I should get the notification as soon as it becomes available. Okay. All right, we got that now. So we've got 4 minutes for the Fed FOMC notes to come out. We're going to go ahead and take a look at a few of the other market conditions. So right now, 2-year yields have been surging for the last, I'd say about the last several hours. We're currently at 4.5% on the 2-year yields. On the 10-year, also moving up, getting ready to test its 5-minute 200 period EMA. It has been moving up since this morning. It is now up 1.5% rate of change. That brings it from 3.7% to 3.752% on the yields. So yields moving up, not a good sign for the market. Dixie is currently down, but basing at around 106.36 on its price chart. So this is the dollar index. It does appear to be double bottoming right here. It does have a two-top formation here, though, and it is early, so we have to wait and see. If Dixie starts to rip to the upside along with the yields, then that would typically signal a big sell-off in the market. VIX is also finding support here, so the market is getting nervous. There's hedging going on right now. Gold just got smacked on a big meteor candle right there. The 5-minute chart shows this big gravestone candle you see here at the top. That's a very bearish signal, and it pushed all the way back down, breaking through a previous level of support only an hour ago. HYG moving back down. SPY versus HYG. Let's go ahead and compare these two charts together. HYG is finally set up a new higher high, but it's only a slight one, and it does have a very tall wick on this candle. HYG, SPY over HYG ratio chart is showing a bearish crossover on the MACD. That's typically a bearish sign showing market sell-off to come. If the SPY does end up moving here in the next couple of minutes, then don't trust the first move. If anything, it's wise to get yourself a hedge in both directions to get started. And then once the market moves in one direction, take profit on that position, hold on to the other hedge. Let's see. Right, HYG, Qs, and Dow Jones. Right now, the Qs over Dow Jones is starting to show more weakness. This is not Qs and Dow Jones. Why is the HYG on?
All right, we got action.
We got action. All right. So, refreshing. We're waiting on the FOMC notes. I'm not seeing it. Time for the notes. Come on. Where are they? It's not showing up on the page.
VIX trying to move though. Volatility coming in. I always trip out on the size of these wicks and candles whenever something major like that happens.
Right? Does get pretty crazy. I'm refreshing the page and it's not showing up. I don't see the notes anywhere. If somebody does happen to have the notes and is willing to drop a link for me here in the live stream chat, that would be immensely appreciated.
The VIX just took a big hit. I'm watching the 1 minute right now, so candles are going to engulf each other for a moment.
Mm-hmm. Here we go. Minutes of the Open Market Committee. All right, we got them. Okay, so now I'm going to have to read through this with my slow human eyes while all of the algos start trading ahead of me. All right, open meeting committee. Let's go ahead and read through this. Scroll past everybody's names. We don't care about them. We only care what they have to say. Began discussion with ethical standards and acknowledged great privilege and heavy responsibility, blah, 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 blah. Yeah, we know. You guys are so ethical and moral. Period. Financial conditions tightened. Yeah, SPY is moving fast. I'm going to keep the SPY over here on the chart.
Contestant, the Federal Reserve in the minutes too. It's early November.
Oh, somebody's hot micing. Okay, we got that over there. Let's go take a look.
Do you want me to play the Fed minutes from CNBC?
Notice the qualifier. A few suggested it was better to wait.
If you just give me
Just real-
the if you just
real
give me the
quick.
link.
So that is not where.
If you could just give me the link, Boule, that'll help.
I'm not gonna lie, I'm watching it on Cody.
You're watching it on Cody. High odds on a 75 basis point increase in target range at the current meeting. Contacts were increasingly focused on the question of when the committee might slow the pace of future increases in light of substantial tightening of financial conditions. Most respondents viewed a 50 basis point increase in the target range for the federal funds rate December meeting as most likely outcome. That's what they were looking for. Okay, so positions long. It's basically like make a run for the bulls. So everybody is positioning long right now.
Y'all keep in mind, everything's got to breathe at one point.
They're pushing the market in the near term. I would still say have a hedge for both directions, honestly, because this move may have been priced in. Manager pro tem. I'm going to adjust my screen a little bit for you here, guys. Stand by. All right. So we're watching this on the 5-minute. And I'm reading over on the right what's going on with this with these Fed notes. I don't know if C-Dub is around, but if he's got his own opinions here. Purchases and subsequent cancellation of some announced expansionary UK budgetary measures resulted in a retracement of much of the earlier increase in gilt yields. Elevated volatility in international financial markets contributed to volatility in the U.S. core fixed income markets. U.S. Treasury securities, some of market implied volatility approach pandemic-era levels. Spreads of yields on agency mortgage-backed securities over yields on Treasury securities widened sharply, reflecting the sensitivity of these spreads to increased volatility. Increased volatility appeared to contribute to a decline in measures of market liquidity in core fixed income markets, in particular around the period associated with UK volatility, but market functioning remained orderly. Looking for anything else important in these notes while we're watching the SPY, it seems like it just rejected off of a high. We just got a really strong rejection here. Very strong rejection. Bearish divergence on the RSI as well.
Looking at the SPY on the daily,
Mm-hmm.
it looks like it has a little cut forming. Very end. Things can get real wild if it breaks right here. Looking at 410.
That's interesting. Let me go take a look at one other ticker really quickly. This is one that was on my list for a minute. Walmart is acting really strange. Okay. That's all I needed to take a look at. All right, so SPY. Still holding up. So it did not get that rejection. Technicals still look good. Volume direction candles are moving bullish, and we're getting a bounce off the MACD. The RSI does look like it hit a top, but we have to get a confirmation candle on this close. This does not mean that it's done moving to the upside. All right. Manager Pro Tem turned into overnight reverse repurchase facility remained fairly steady other than during the period surrounding quarter end. In the period ahead, the relative pace of decline on ONRRP facility balances and reserve balances would depend importantly on shifts in money market conditions. They're expecting reverse repurchase to fall in usage. So we're moving on to the economic situation review. They are estimating that U.S. real gross domestic product is increasing moderately in the third quarter and after declining for the first half of the year. PCE remains elevated. So that information we already knew. We're starting to see the SPY reject really strongly right now. So what's really interesting is that right away in the very first paragraph of their notes, they immediately answer the question of how likely are we to get a 50% basis point hike, and they said it's the most likely outcome. And then afterwards, they go straight into the financial situation with PCE, and they point out that everything, including consumer price inflation for residential, is extremely elevated and is causing headwinds for them to fight inflation. Credit quality remains sound overall, but there are signs of deterioration for lower rated borrowers. So subprime loans are starting to see credit quality declines, meaning that people with less income, with less qualifications, are being approved for loans. This is kind of reminiscent of what happened in 2008, where as financial conditions grew tighter for the market, banks started issuing out more subprime loans in order to make up the shortfall by taking on more risk of default. I'm gonna drop down to the 3-minute, not the 1-minute. It's a little too noisy. So far, SPY is looking strong still. We got our initial pop of volume to the upside, and volume's been dropping, but the retracement is very slight. It's a 60. It hit the 62 level on this 3-minute chart. If I go all the way down here, then this makes it a 50% retracement. Not even. SPY bounced off the VWAP. It's honestly less. It's less volatile than I was expecting. Really, John Friedman. I see your message. John Friedman says I was a subprime loan officer back in 2008. Got out just before the house of cards fell apart. Thanks, Jen. I appreciate that. Shout out. General disarray. SPY dumping. Oh, yeah. Hey, Zargert. Nice to see you, my dude. What's going on? It's good to see you again.
I wouldn't count the SPY out just yet, man. It's volatile. It's been going swaying.
It is volatile. Like I'm really cautious here. I'm kind of sitting on the fence still as I'm reading through this because there's mixed messages in these notes. They say that the 50 basis point hike is likely, but then they immediately go on to say that PCE inflation pressures are causing rises to core inflation and making it difficult for them to put more pressure on the market.
Maybe this time we're just really, really early. No, I did expect way more volatility though, to be honest.
Yeah.
I mean, it did get a little jumpy right there for a moment, but I expected more.
This kind of leads me to believe that we're closer to the top than we thought.
Cosmos is over there struggling to hold a 50% retracement.
Well, that's slightly disappointing.
Yeah, it's right there. You know, it's just below it. The 5-minute candle opened up below it. But maybe this candle can push up above and close, above it. I don't know. I'm out of it. I'm still waiting for another entry.
Yeah.
It's ran so much. It's got to have a little bit of retracement, just a little bit.
Interest rates on existing credit card accounts are continuing an upward trend, reflecting increases in the federal funds rate that were quickly passed through to prime rates. They're seeing the reaction that they wanted to see. Credit remained available in the residential mortgage market for borrowers able to pay high interest rates. Sure, for now.
I'm gonna have to put this out there real quick.
What's that?
We got a lot of pressure building up right now.
Yeah,
What
how?
happens with all this pressure?
What do they say about pressure, though?
Bust pipes.
Pressure bust pipes. All right, so on the 3-minute, we're seeing the volume direction candles really pushing the upside. They're flagging pretty consistently right here with a level of support on the volume direction candles. We are getting bearish crossover on the MACD. Where did my MACD just go? My MACD just disappeared. My PCO just disappeared. What the heck? There we go. That was weird. All right. So RSI is bouncing repeatedly off of its midline and moving average. So this is a sign of continuation. MACD crossed down to the downside. So momentum is slowing a bit. Volume direction candles are still basing. We haven't seen it break yet. If this candle continues to close green, then we can still see more buying pressure.
Looks like this strike thing is getting a little bit more steam, huh? For the railroads, that is.
Yeah, that was one of the catalysts that I've been really closely monitoring. So the unions, the rail unions, voted on Monday whether to accept a contract from the largest railroad companies, and they denied it. So that automatically means that they are considering organizing a strike. Very likely that that's going to start right away, at least going into the first week of December. That's going to put massive pressures. That's going to put massive pressures on logistics and transportation. So Biden's going to have to step in. Congress will have to write up a deal to get to placate the SMART rail union. That's SMART TD. That was the rail union that voted to reject the labor deal. It was pointed out that I believe it was the engineers that denied it, or it was conductors. I'm trying to remember which. One of the two accepted, but the other denied. I think it was conductors that did not like the deal. So they declined, and that means they're going to strike. So the rail union altogether is going to step off the job site. None of them will cross their picket lines, and this is going to force the railroads to accept a deal that's better for workers. So however that ends, We'll probably find out in a few days to see if there's going to be a congressional intervention, but that's something to keep your eyes on, because the longer that goes on, the worse it gets for the American economy. It doesn't just affect the rail companies; it affects everybody.
Estimated on chemicals a week, they're saying $2.4 billion. Come on, man. Why are you playing with that much? Why you got that much power to play with us like that?
Staff Economic Outlook shows that the projection for the U.S. economy activity prepared by the staff for November FOMC meeting was weaker than the September forecast. Broad financial conditions were expected to be considerably more restrictive over the protection period than in December, reflecting both recent market movers and upward revisions to the staff's assumptions regarding the future course of monetary policy based on recent Federal Reserve communications. As a result, output was expected to move below the staff's estimate of potential early in 2024 to remain below potential in 2025. Likewise, the unemployment rate was expected to be above the staff's estimate of its natural rate in 2024 and 2025. On a 12-month basis, change total PCE price inflation was expected to be 5.3%, and core inflation was expected to be 4.6%. So they massively underpredicted, they underestimated PCE and overestimated unemployment rates. And they still haven't gotten what they wanted. Strong wage growth and the effect of supply constraints on prices would persist longer than previously thought, with the effects of supply and demand imbalances in good markets expected to unwind and the labor and product markets expected to become less tight. Staff continued to project that inflation would be declining markedly over the next 2 years in 2025. Both to potential and core PCE price inflation were expected to be 2%. With inflation remaining so stubbornly high, the staff continue to view the risks to the inflation projection as skewed to the upside. For real activity, sluggish growth in real domestic product spending, a deteriorating global outlook, and tightening financial conditions were all seen as salient downside risks to the projection for real activity. In addition, the possibility for a persistent reduction in inflation would require a greater than assumed amount of tightening in financial conditions was seen as another downside risk. The staff, therefore, continued to judge that the risks to the baseline projection for real activity were skewed to the downside and viewed the possibility that the economy would enter a recession sometime over the next year as almost as likely as the baseline. That is a scary statement. So the staff are now saying recession. Fed staff are widely considering that we are going to move into a recession period. Okay. In their discussion of current economic conditions, participants noted that recent indicators pointed to modest growth of spending and production. Nonetheless, job gains has been robust in recent months, and unemployment rate has remained low. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressure. Participant recognized that Russia's war against Ukraine was causing tremendous human and economic hardship. The war and related events were creating additional upward pressure on inflation and were weighing on global economic activity. Against this background, participants continued to be highly attentive to inflation risks. With regard to current economic activity, near-term outlook, participants observed that although real GDP rebounded in the third quarter, recent data suggested that economic activity in the near term appeared likely to expand at a pace below its trend growth rate. Participants noticed a softening in consumer and business spending growth, and some participants remarked that there had been a notable slowing in interest rate sensitive sectors, particularly housing, in response to the tightening of financial conditions associated with the committee's policy decisions, with inflation remaining far too high and showing few signs of moderating. Participants observed that a period of below-trend real GDP growth would be helpful in bringing aggregate supply and aggregate demand into better balance, reducing inflationary pressures and setting the stage for sustained achievement of the committee's objectives for maximum employment and price stability. In their discussion of the household sector, participants noted the growth in consumer spending had softened. So they're expecting GDP to continue declining. They're talking about recession, and they're talking about further tightening of financial conditions. I don't know how they're going to. I don't know how they're going to fight that with a 50 basis point hike.
It looks like IWM caught a bid. SPY right behind it. Don't
I'm
sleep
gonna see
on
if we can
Bobby
get.
though.
I'm gonna see if we can get C-Dub in here to give us his take, because C-Dub is very focused on the Fed FOMC. He's telling me that there's no surprises in his opinion, and he did go long on the SPY as soon as the notes released. We're starting to see some buy pressure coming in, so to me it looks as though the market is getting ready to move to the upside. But I do want to get his comments on what the market is likely to do and what the Fed really means when it's going into this detail about a potential recession. So hopefully C-Dub will join us here in a few minutes. So I'm going to take a look a little bit further into this. So far, to me, it looks like the SPY is going to move up in the near term, but we need to be really careful here. I don't know about 410. Let me go analyze the rest of the SPY, how much room it has left to go.
Yeah, definitely not something that's going to happen soon. But if you look at it on the daily,
Yeah, SPY can move up to SPY can definitely move up 1.5%. It could certainly do that. 410 by Friday is achievable. What I'm nervous about though is when the rug pull is coming, because the SPY's been ripping for a minute. SPY's
that's
been
why I
ripping
got these
for a real
puts
good.
in the back burner just sitting.
The labor market's been very tight, unemployment rate near a historic low level, number of job vacancies very high, low pace of layoffs, robust employment gains, elevated nominal wage growth. The healthcare sector, leisurely and hospitality or construction face particularly acute labor shortages. No surprise there. These shortages were contributing to especially strong wage pressures in those sectors. Participants commented on the labor market having remained strong to date, even alongside the slowing economic activity. So I find it interesting they call out the healthcare sector in particular, construction too, but healthcare sector has been getting underpaid for a long time. And honestly, like it's not even just about the money anymore. Healthcare sector, like doctors and nurses, especially like in emergency rooms and inpatient care, they're not getting treated well. Like those, I feel so bad for those folks. I've known I've known a few nurses in my time, and I am my wife was a former nurse, and I can't believe what she went through on a daily basis in her career. Just the way that not just the patients but the administration treated her and her colleagues. and like the constant threat of lawsuits and all of that. Like it's gotten to the point where like healthcare it's not worth it to be in the sector anymore. It's not worth it. There's just too much risk that you're exposed to. The SPY is really, really getting spicy. Yeah, rail strike would be good for diesel supply, but the whole point of like the scare of diesel supply is that it would cause trains to stop. So if the diesel supply rises because the trains have stopped moving, because the railroads have striked, it like it's not a bad thing that diesel supply is growing, but like that was the whole reason for like being worried about diesel supply going into decline. So, you know, like take it for what it is, I guess.
I hate you, dreaming. C-Dub here. Can you guys hear me?
Hey, C-Dub. Yeah, I think your mic's a little bit low. I'm having trouble picking you up. Would you mind turning it up just a little bit?
I will try.
I'll see what I can do. Oh, hold on. Wait a second. Let me actually try this. Try and speak into the mic one more time.
How's that?
That's perfect.
Okay.
So we were looking at the SPY, and I was going through the FOMC minutes. I saw the first, like right away in the first opening statements, that they focused in on a 50 basis point hike being likely, but the economic outlook continued to discuss like they actually said that they expect a recession now. They're expecting the next quarter GDP growth to be well below expected trend. And PCE inflation is continuing to give them trouble. And the labor market's still super strong, unexpectedly so. So since you pay so much attention to the Fed and you're really familiar with interpreting their language, what were your thoughts on the minute notes?
Well, I think it was fairly in line with expectations, right? So this is the notes from the meeting, from the November meeting, which was before we got the November PCI data release for October, right, which was below expectations. So all of this is based on CPI data from the last iteration. So I didn't see any surprises here. It was pretty much in line with what I expected. The looks like the consensus for the terminal rate is going to be, or for the next set of rates would be 50 in December, 50 in January, 25, or I guess it's February actually, and then 25 in March, and then a stop. So that would be the terminal rate that would put that at 5%. That's right in line with the Fed, where Fed futures have been. If you look at the Fed futures going out till April, they were about 5%. It's about the same now looking at September. I don't have December in front of me. If I had to guess, it would come down about a quarter point. So I don't see any surprises here. I think the market sold off. It was kind of a violent sell-off. I was a little surprised by the volume that came in on that sell-off, but I think it was just profit taking in front of the minutes in case they were more hawkish than expected. You can see the market bounced right back after that. Went up, tested, looked like we double topped right off that little under 403 again. So we'll see if it can hold VWAP here, but again, I don't see any surprises here. I think this is right in line with what the Fed's been telling us, and I don't see any changes based on what they told us at the last meeting.
All right. So then, are your expectations for the SPY to follow seasonality? We've been paying very close attention to the seasonality chart. I'm not sure if you're watching the YouTube stream, but I've got the Trader's Almanac seasonality patterns set up right here, and according to this, we should be going into the holiday rally basically this week, immediately following Black Friday. So is that in line with your expectations, or what do you see here?
I think we're likely to see a pullback. So I think the market is free to move up to about 405, 406 right now, is what I'm expecting. I actually did jump into some calls on the initial pullback. So we had that initial move off the minutes where it pushed back up to 403 and then pulled back. So I did grab some relatively short dated calls for me, 2 weeks out. I got some 405s. I've taken profit on that already when we retested that in case we just get a double top rejection, which is not looking super strong right now, but I'm positioned that I'll cut these if we get back below the close, so about 400.
Okay.
I think if I had to guess, most likely scenario, I think the market is going to move up and test that 200-day, which is right at that 405 area, right?
Right.
I think it's likely to reject there on the first attempt and pull back, and you could see a pullback as deep as maybe like 390, 391, 392 area, something like that, right around where that 100-day is sitting right now.
Okay.
It might not get all the way back there. It could, there's definitely been 395 has been a fairly significant area. No, it's not, the 390 level or the 402 level, but we've seen it react there a few times on pullback. So it's entirely possible, we get back there. But, overall, I do expect a move up, a move back. And then I think I think we're positioned for the end of the year Santa Claus rally at this point, which would take us through the 200-day. Probably, I haven't done a full TA on these levels yet, but just giving it a quick eyeball, I think you'd get to, at least the 410 range, more likely probably up to 415, maybe 420 if things get really exciting. There's a lot of reason to think. So there's a lot of fund managers that have a lot of money on the sidelines, right? And their job is to outperform the market. So if the market goes into rally mode at the end of the year, they're going to chase it because they need to pump up their numbers going into the end of the year. It doesn't mean it's going to sustain it. I don't think it's going to sustain it in 2023, but you'll see big money, institutional money pumping that move. So if we go up, test the 200 or the 200-day, pull back, and then pump through that on a Santa rally, I think you're going to see some serious volume come in and prop it right up.
Do you think that it would get significant enough that if we actually broke this megaphone pattern that the SPY's been creating on the daily chart, that we could actually see it overshoot it to like 420? That would be my most extreme case, because I don't think that it can retest 430 in this market, not until we finally get inflation under control and the Fed stops the tightening. And even once they get inflation under control, they can't just unwind the tightening and just like go back over into QE mode. So
no, and I don't think they've done much in the way of QT.
Neither do I.
I was looking at the balance sheet yesterday, and it's down less than $1 trillion, right? From almost $9 trillion to like what, 8.5, 8.3, something like that.
Yeah.
That's probably just letting securities mature or mature securities fall off. I don't know how much actual selling they've been doing. I think 415 is the target. Just looking at that, you've got the early March, you can see that double bottom off of 415. In May, we came up and tested that as resistance, banged off that a bunch of times for like a week straight before the big drop, right? And that was a CPI driven drop. So you can see 415's reacted to it a lot. I don't have a volume analysis up in front of me, but when I looked at it previously, it definitely 415 was a huge volume area if you go back throughout the course of 2022.
Yeah.
So to me, that looks like the target area. I think we could certainly overshoot that to 420. That's not too far a reach, because when I say 415, you could even call it 417, right? So 420 is right there. I agree with you. I don't think we're getting past that. Maybe we wick past it a little bit on the daily, but I don't think we're closing above that level. I'd be really surprised.
That's
one thing.
Go ahead, Logical.
The only thing that I would say is one thing to keep in mind if you're looking for a reason to get above it is we have 3 weeks worth of significant data pieces that are coming in over the next 3 weeks with FOMC, CPI, PPI, and PCE, all of that stuff over the next 3 weeks. We might not break that in the next week and a half, but if all of those numbers come in and significantly beat and keep adding to the upside pressure with the Christmas rally, like it could give us enough in order to keep pushing up there. The max top that I would see would be 430. Like 430, if we had enough strength to push above 430, that officially sets a higher high on the bear market, which I don't know if there's enough behind it right now to signify that, with interest rates, I mean with like inflation rates and everything still what they are. Without the Fed actually pausing or reversing, I don't know if you can break and set a higher high on a bear trend at that point.
That's exactly how I feel about it. And yet, like, we still see the market pushing when, like, I still see the QT being talked about, but never really, like, the Fed could be doing a lot more right now. This is the balance sheet right here in front of me. They haven't even declined like by a full trillion. They've only really declined by like half a trillion. So the balance sheet is still way out of whack. In my opinion, like they need to be accelerating in order to actually put some pressure on the market and the inflation problem.
Yeah.
Like if they wanted
how much of that decline is just, everybody's down, right? It's 2022. The market's been down, so they own assets that are worth less money. So it's their values are gonna come down. And like I said, the other thing is just not letting maturing securities, bonds fall off.
Right.
Yeah, they haven't gone at this hard like they said that they were going to in the beginning of the year. Whenever they kept mumbling the stupid word balance sheet, all you had to do was not say the word balance sheet in those first couple Fed meetings, and things would have been able to hold on. And they just kept saying it. That's it.
I think we just lost Logical there for a second.
I'm back. Can you hear me?
Yeah, we can hear you.
All right. Yeah, all I was saying was like that was the beginning of those in January when they kept muttering those words balance sheet. That was where the zebra thing came from, because they kept saying balance sheet, and it was like, you have one job, just stop saying that word. And every time they said it, the market dropped, and they haven't even done much with it since then.
Nope, they have not. We had Fed tailwinds for a long time that was driving that market, and like you said, I forget which report it was, but we first started hearing that. Actually, that was the January 2022. Yeah. We got the December minutes, and that was really the first time you started hearing about that. And that was the beginning of it.
Yeah, that was the January FOMC meeting is where the zebra title came from, because I was screaming while they were having it, telling him to stop saying, you have one job, stop saying the word, like just stop saying balance sheet.
If the word was zebra, just don't say zebra, and then they say it 17 times.
Yeah, that was it.
That was
you have one job.
Yeah. So I'm bullish for now. Above 390, I'm bullish on the market until 2023. I think you're going to get. I don't see any reason. So we're going to get the next CPI report, right? The day before the next FOMC statement or policy change.
Right on.
So they're going to have, since the last one, they're going to have two. We already know the October data was positive. So if the November data comes in and it shows continued improvement, and remember the Fed said multiple times that one data point is not enough, right? So if the market sees two data points and all the other supplemental stuff that's coming in the meantime is all supporting the bull case, right? The job numbers are still strong, but they're starting to go down a little bit. You're also, and it's not going to show up in the numbers yet, or quite yet, but you're seeing layoffs. There's a bunch of big tech companies announcing layoffs, so you're starting
initial jobless claims today came in hotter than expected too. So like that goes to what you're saying, is like they're not crazy hot, but they're starting to get there.
Oh, the VIX just went below 2050. Wow.
One thing that I am paying attention to, along with what you were saying with the with all of the stuff kind of going in the right way, the one thing that I am seeing as a repetitive point that they keep pointing out to us is, hey, it's not about the amount that we're hiking and how fast we're going. What everybody needs to start paying attention to is the destination of where we're getting to. And to me, what that means is they're really focused on the target Fed funds rate for years out, not what it is by the end of the year at this point. They're looking at 2023. They're looking at 2024. The only piece that I'm mainly concerned about right now is in the projections that come out for December. So we get them quarterly. The next projections that come out are December.
Yep.
I'm concerned if those projections move up for later in 2023 or 2024. If those projections move up, that could signal to the market that the pause isn't being expected, or there isn't going to be a pause, even though it will be less of rate reductions consistently.
Right.
You know what I
It'll
mean?
just
Like,
be more
instead of-
consistent, lengthy, drawn out process, which in my opinion is not the way to go about it, but like I'm not in control of monetary policy. So how I feel about it probably doesn't really have much bearing. But if it was up to me, then I would have liked to see the Fed rate hikes a little bit more aggressively. Like we're one of the only superpowers that didn't do a 100 basis point hike. And we ended up lagging way behind, and we ended up creating more inflation globally because of those actions.
Yeah, they're under a lot of pressure too. There's a lot of dollar-denominated debt out there. A lot of people tied to the dollar, so they are under political pressure not to raise the rates here too much because they do impact other countries. So that it's not supposed to be part of the Fed's, they're not supposed to take any political stuff into account, but we all know they do. So that could be part of it. But I think Logical brought up a great point there. We get the SEP in the December meeting, so we'll get the new dot plot and all that stuff. And right now, the market's been coalescing at 5% ish, for their terminal rates. If we see anything above that, the market will sell off hard because of that. I mean, I can't say whether we will or we won't. It's just a guess. There's nothing. We don't have any data. I haven't seen any data that suggests that they'll need to go higher than that. But they might already be planning that, right? They're always lying to us, right? They always slow roll it. They said they were going to go to like 3.5%, 3.75%, and we're well past that. So they're going to change based on the data. So as long as the data suggests that they don't need to, we have no reason to think that they will. But that's a big one. That CPI release in December is going to be, it feels like everyone's the biggest one, but that's going to be the biggest one. We'll see what we get. But all we can do is wait and react to the market, right? It's trying to predict the market it's a tough game.
It really is.
You're better off waiting and reacting, in my opinion, to what it gives you. As far as being a trader goes, investing is different. You can dollar cost average down. You buy Apple here, you're not going to regret it 10 years from now. It's easy peasy.
So the way that I'm looking at this, C-Dub, and just because I don't follow your strategy as much, but you're more of a day trader, right?
Oh yeah, almost exclusively. I generally like. Okay. Yeah, I like to be cashed. I mean, if I swing something, and I do, but generally it's a position that I started and I took profit on, and I'm out of, say, at least 50%, typically 70-75% of that position if I'm going to carry a piece.
Right on.
And that's this market. That's the 2022 bear market. You got to be nimble, and swing traders, I think, have a much harder time in this kind of an environment. I want to be neutral. I don't want to have a bias. So if I don't have a position, I don't have a bias, and that works for me.
That's a fair approach. Well, I was going to put it to you this other strategy, because I am a swing trader, and I would agree that the market is a little bit harder to predict, because trying to play tops and bottoms on these swings has been one of the most difficult things. But one strategy that has worked for me so far is looking at ratio charts of the SPY versus the HYG high yield grade bonds.
Yep, absolutely.
Have you been tracking this strategy as I've covered it while I've been throwing them out onto the YouTube channel?
Not specifically, but HYG is something I keep tabs on, because if you start to see an inversion, versus the SPY, it's usually a very bad sign for the market, right? If HYG is selling off, or LQ, what's the other one? LQG?
Right. Like exactly right here at the top of every single market where HYG had its first big, red sell-off candles. it always led the SPY pretty quickly. And we would see, like, the first thing that I would see is this bearish crossover on MACD on a SPY over HYG ratio chart. And it was
Yep.
consistently accurate. Like, every single sell-off was marked by this crossover. And maybe it didn't quite work out early on, but as soon as we entered into the bear market, like, those crossovers were extremely dependable. And HYG dumping as SPY was going up was almost always, this was the best trade so far for me, was seeing HYG dropping this fast while the SPY was going sideways and making a diamond top formation. Like, that was the best trade, because I was able to swing a put. I was able to swing puts for just 30 days, and they were so damn far in the money. I think that was like a 500% profit just swinging this as soon as it like had this morning star candle on the daily. Closed it the next day on the gap up for a huge profit.
Yeah, I had some nice puts there too on that section. That was nice. What I was doing is I'll do what I call like a core trade. Oh, hold on a second. I gotta take a little profit here while we're up here.
Well, while CW is doing that, I'm looking at HYG, and it did just break a new high. So at the moment, HYG does seem to be agreeing with the SPY, so they are moving together. That's what I was waiting for, was to see if HYG was going to break this two-top pattern, if it started moving to the downside after this two-top, because this inverted hammer candle, or hanging man candle, as some might call it, that one started making me really nervous. So as soon as I saw this candlestick, I was thinking, like, okay, if HYG rejects here and the SPY keeps going up, like, I'm going to be really nervous to be playing calls. But HYG seems to be in full agreement with the SPY's move to the upside. FOMC minutes are relatively like bullish. They've just, as CW was pointing out, the notes were written before the CPI report came out, which, as we all know, that was a huge win for the market. Everybody saw CPI data come in bright green. So, or what I should say is the CPI was a lot cooler than usual. So we were into the 7th percentile rather than like mid 8%. So we came in well below target. So CPI was extremely bullish, and the market loved every second of that. So that by itself was good enough to go long in the market from that point forward. What we were really waiting on was to see if they were going to toy with the decision of a 50 basis point hike, and it seems that they have agreed that will be the likely outcome. They weren't willing to give the correspondence at the Fed with their last speech any kind of lead on what the decision would be, but the notes have all but said that a 50 basis point hike is going to happen. So, with that being the expectation, as long as nothing else bad happens, like as long as CPI report comes in cooler than usual, then we may yet see another push in the SPY. We'll just have to wait and see.
We were actually having a conversation about that in the regular chat this morning. I gave some, and I actually the reason I want to talk about this real quick is I want C-Dub's opinion on this as well. But essentially, what I was explaining in the morning was that if you go back and you look at the actual CPI number that came out towards the end of 2021 every month, and then all throughout this year, there is a very large jump in that CPI number in between October and November and December of 2021. Those massive jumps that happened back then are less than the jumps that are happening now. So when you're looking at the year-over-year numbers that everybody is keen and pinpointing on these projections that are coming out, when you look at those numbers and you have a starting point that is aggressively increasing and a current point that is relatively flat compared to the starting point that's aggressively going up, you will start to see the year-over-year numbers drop. And I mean, that's just math. Like that, the way that works. What I'm expecting to happen for December, based on that, is you see another very large jump between November of 2021 and December of 2021. we are not increasing at that rate anymore, which means that if that's the case, we should see another significant decrease year over year whenever the December number gets released.
Yeah, no, absolutely. Has it, the longer it goes, the harder it gets to maintain those numbers, right? Because if it's
Right.
just, it could stay, inflation could stay at this outrageous level, and the number's just going to go down, right? Because it's not actively going up anymore.
Right.
Right. And that's the part that that's the part that we were talking about earlier, where it was, even though you see the year over year numbers going down, look at the month over month numbers. They're not reducing by a ton. You know what I mean? Like they're slowly coming back down, but we're still extremely elevated. Like we need to see those month over month numbers go negative.
Yeah, absolutely. And I think that's the Fed's game plan. They think that, and now this would be, I believe, the first time in history that they have not raised the Fed funds rate over the inflation rate and got it to come down. So their game plan is they think if they can keep going, that inflation will start to inflect down, and that the terminal rate of 5.5 will be enough. Bullard came out the other day and said 5 to 7 or something, or 6 to 7, which I think everybody would be surprised by.
Yeah, that melted things in the morning.
Yeah. But they don't say that by accident either, right? They say, hey, the market's getting a little too hot. Let's cool it off with a little Fed talk today.
Yeah. I whenever they came out with the release on the press release at the FOMC that they came out at 2:00 before the press conference, I said then, reading that note, that what you're going to start to see moving forward is you're going to start to see people all over the map. You're going to see people that are saying we should be at 7. You're going to see people saying that we should pause. You're going to see people saying all kind of different things, depending on what they're trying to get the market to do at any given moment in time, to stop a run, to get it off of a floor. Like, you're going to start to see them play with things now that we're getting into that period where we've upped the rate enough that they want to see what's happening, but they don't want to look weak and pull it back. So they're going to have all kind of different. They're going to have the doves are going to be dovish, the hawks are going to be real hawkish, and you're going to have everything going different directions right now in order to try and figure stuff out. They're not all coming out and saying we need to increase and go to 7. Like, that's not going to happen. You're going to see people on both sides of the fence at this point.
Yeah, I don't think anybody realistically thinks they're going to have to go to 7. I mean, the things would have to drastically change, right? Nothing we've seen indicates that they'll need to go that high.
Right.
I've been on the 6% fence for a while. I think that is the area that, at least that I thought it would likely get towards. And if it goes to 5.5, like that's within the margin of error for me. That's close.
That's essentially what I was targeting too. I was looking at in between 5.5 and 6.
Thank you guys for the thoughts. I'm really appreciating the discussion. This is what I wanted the stream to be more like when we got to do this at first. Before we keep going on the SPY, I just wanted to shout out to chat. If you guys are enjoying the stream and the content and the discussion, be sure to leave a like, and that helps bring more folks in here. And if you aren't already subscribed to the channel, we do stuff like this all the time. Usually we're covering the SPY, but we're also looking for other major market movers and any potential runners in the market. So if you want to get alerted whenever that happens, be sure to subscribe, hit the bell icon so you get notified. And let's go take a look at some other tickers. Looks like SPY is getting some pullback on low volume.
Yeah, it's struggling up here at this high of the day. We didn't quite hit it again, but I mean, that's close enough to call a triple top. You can see there's a little bit of volume coming in on that last pullback too, which my calls don't like, but I'm out of 50% of that position now. Certainly not a home run, but yeah, we'll see. We all know how it is. It's almost algo time, so it's 3:00 power hour.
Going into a long weekend.
Yep.
Yeah, holiday week. I don't know. I'd be kind of surprised to see it break through at this point. My play here, again, me being the day trader that I am, was we we got up there. The sell-off was the early sell-off pre-minutes. It's more aggressive than I expected it to be. We did actually go red for a second there, but that was just a little liquidity grab probably.
Yeah, that's kind of how I look at those moves because it's low volume, and then you end up printing these bull hammers, and I always read those as just a quick stop loss hunt, just looking for some liquidity before driving the market again.
You guys aren't going to be trading on the half day Friday?
I probably will. You know my degenerate butt.
Yeah. It's volatile. Last year it was super wonky. That was a real bad day.
Oh, last year was awesome. I was sitting on a lot of puts that I probably should have already stopped out of. And I woke up Friday morning and the market dropped quite a bit.
Yeah, it did.
I did really well on that as I drove home. My 4
Was that based? Is Friday, is a lot of the volatility that's going to come in on Friday, is that based off of the preliminary numbers that we're going to get on sales and things that are happening throughout the day?
I forget what the catalyst was last year. Something came out, and I don't remember what it was. There was a specific news catalyst that dropped it that Friday morning, so I essentially just got lucky. I was in a position like I said, I probably shouldn't have been. I don't think that this Friday is going to be particularly volatile. I don't know any reason that it would. I mean, you might get kind of a low volume melt up or something like that, depending on what the market wants to do. Like I said, I think it wants to move a little higher before it pulls back. So you might get that Friday.
If I'm going to be playing any Christmas rally, for me doing the swings, I do read this entire pattern here as continuation. I know that it's got a lot of people nervous, but we've had one touch here on this liquidity level, and now we've had 3 tests of it and one big pullback to VWAP here. Actually 2, now that I look at this. And I read this as a double bottom, so unless this breaks this low, then I'm not going to be even slightly worried. For me to actually get concerned, I need to see the market actually break down below these levels. Because this whole formation, easily an inverse head and shoulders, that already played out to the upside. So as long as this support is being held, I feel pretty good about this one going to December 16th. I just realized that I made like an ooh smiley face by accident.
Sure, it was an accident.
I promise. It was totally an accident.
Yeah, no, absolutely possible.
I mean, that 401.32 is a magnet in the previous months and stuff.
Yeah. What's the VIX doing? Still struggling right now here at the VIX. Dollar index is still low.
Yeah, I got an alert while we were on here that I had one set for 20.50 as I start to look for signs that it wants to reverse.
Right. Well, momentum is still strong to the downside, and RSI rejected off its moving average, so VIX looks like it's coming back down. My expectation for VIX is if it retests 19 again and immediately bounces here, if I start to see this same action, like this kind of like up, down, barcode chop on VIX down here at these levels again, that's when I'm going to get interested in some puts on the SPY. I'll closely watch it. We don't really ever get bullish divergence on the RSI, but anytime I see the RSI on VIX start to get like really, really tight and choppy, that's when I start to get really nervous about the SPY. So we got one more cross down on the momentum indicator as well. So now all signs point to a market rally.
Yeah, and another thing I like to keep an eye on is XLY over XLP. So
I use that one too, yeah.
Yeah. So that's been green the last 2 days. We know we double bottomed off this level here. So that's a good sign for continuation for sure. Because if that's going down and the market's going up, it's not a good sign.
Yeah, you said XLY over XLP is your chart.
Yeah, I keep an eye on that one.
All right, good eye. So yep, I do see it. It did kind of undercut support here. but now that it's reclaiming, as long as we see this moving to the upside, then that would be a good sign for the discretionary sector, which is a risk-on sector. If you think discretionary, think clothing brand retail. I think vehicles, EVs, are also included in this sector, although they're kind of like intermingled with technology.
I think Tesla's one of the bigger weights in XLY.
Yeah.
So that's not helping.
Yeah. Excuse me. So
poor Tesla.
Yeah, Tesla got absolutely hammered, but the way that Tesla's looking right now, it could come back pretty fast. I'm waiting for the RSI to start cooling off. I was short on Tesla for a while, and I ended up not taking as much profit as I should have because I got my entry way too late. Kind of chased on that one, so that wasn't my best move. But now that we're crossing on these volume direction candles for the second time, I'm kind of thinking of long positions in Tesla going into December. It's already recaptured support at 179, and that was like my cliff level, and it ended up just undercutting and coming right back with this cup and handle formation.
For Tesla, like I played to the downside the last I think it was 2 days ago off of the drop below this the support level that it had and rode that throughout the day. The 167.54, you have to go back into 2020, but that's a major point back in 2020 where it came up and spiked and dropped back down. That was the target that I was watching for on the drop. I just think that, I mean, it's so oversold. Like, I was actually looking for in between 160 and 152 for an entry to go long for a larger move. I think it may have already. it may not look back. I don't know if I'm gonna be able to see 160 or 152 to be able to enter some longer dated calls. But
I think you'll get a chance to buy Tesla at around 150.
Yeah.
Maybe not this year. You know, obviously, if the market's going to rip into the end of the year, I don't think it's going to go down there in the next week or anything. But I mean, it's had a good day. Obviously, today it's back up over that level. That, you know, like 178, 180 level, 178, 179, big level. So that's right. It's coming right into the EMA 9 on the daily right now. So it wouldn't shock me to see a pullback, come back and retest like 173, the gap from today. Maybe come back, test that tomorrow or Friday, depending on what the market decides to do. But that'd be a level I'd be looking at.
Yep.
For the immediate future.
If Tesla does end up pulling back and the market continues to move up, then I think at that point I'll feel like the bottom for the year is in for Tesla, because this undercut and then huge pullback to the upside was pretty unexpected for me. I thought that Tesla was going to start moving back down to the bottom of this megaphone.
Yeah, I mean, there's not a lot of volume. You know, if you look at the daily below that like 180 level and go back, there's, you know, it shot up and it never traded a lot in that level, and that means there's not a lot of structure there. So once you get into those levels, a lot of times it'll keep going. But I think Tesla was just very oversold too. I mean, it's selling off for a lot of different reasons, right? It's not just fundamental reasons or anything like that. It's, you know, right, pressure from the whole Twitter thing, social aspects of it, all of that right now is contributing to that. So at a certain point, I mean, yeah, I don't think you're going to regret buying Tesla at 160, you know, in your long term.
No.
I'm hoping to get it down in like the 150 area in my long term, you know, maybe 135 if I get lucky. But that's I have an alert set down there so I can add some to my long term.
There you go. If I could see Tesla dropping down to those levels, I would be happy, honestly, because I'm not a Tesla bear by any stretch of the imagination. I just know that, like, at these levels, even after selling off this much, Tesla's PE ratio is, what is it? It's still like 120 or more. Let me go actually pull up the numbers on what it's
Oh, it's
beating
yeah,
here.
it's super high. I don't know what it is right now, but yeah, it's
Seeing
definitely
52.50 price to earnings ratio, TTM 52.50.
52.50. That's lower than I expected. I thought it was still in triple digits.
Yeah, it's come down quite a bit.
Yeah.
I mean, there was a split back in August too. If that would have changed,
I guess that would have, yeah. Well, in any case, if Tesla reclaims this support, the way I'm looking at this now is it was forming and played out this bear flag, but now that it's bottomed so quickly, it looks to me like we're probably going to see a head and shoulders, inverse head and shoulders on this chart. If we did see Tesla come back for the holiday rally, I could see it retesting this 200 level. So if you're looking for a position on Tesla to catch this rebound, we may see some pullback here at the end of the week. But I know that Tesla options are extremely expensive for folks. So there is options for cheaper leveraged shares with Tesla long ETF. So you can say what you want about the wisdom of relying on leverage to play these, massive mega cap tickers. But TSLL, that's Directions Daily Tesla Bull 1.5 leverage shares. You can go long in this one with calls for $12 out to December 16th, and that'll set you back about $100 per contract. Whereas a Tesla contract for a similar price for Tesla to actually hit an at the money call would probably cost you around $800 per contract. So
Yeah, December 16th at the money is right around $11 right now.
it's 11 per share. So it'll actually cost you a little over $1,100 for a single at the money contract of Tesla, whereas an at the money contract of TSLL will set you back only 100, and that can give you 1.5 times leverage on Tesla. So if we do end up seeing a market rebound where Tesla comes back to, we'll just go ahead and set a long strategy on this one and see if it does end up testing this level. Then that would show a 15% return. So you can get a 15% return on just shares to this level. Call contracts, you would see about a $150 return on that if you held it out till expiration of December 16th, assuming that it hit this price level. If there's some time left over, you can probably capture a little bit of that theta value, that extrinsic value on the options. So if it's something that you see potential in, if you like Tesla, but you don't have cash to play it, then TSLL is an option. Tesla is pretty badly oversold at this point, and to go short at these levels is pretty greedy. So I'll hold off on any further shorting of Tesla, and I'll watch it closely for a pullback to see if it establishes some more support down at these levels, and possibly consider a long position.
Yeah, I think you could definitely get up into that upper 190s. I'd be targeting, 200, nice round number, and it could certainly get there. I'd be looking at like 198, 199.
Yeah. As soon as it starts to approach it, that's when you start getting nervous, because then the profit takers are like, "Yay, round number!" And there's an automatic order that's like there's a limit trigger order waiting there, and as soon as it hits that price, it's like, okay, here's the order, bam, and then the price just collapses.
Yeah, Tesla can move, that's for sure.
Mm-hmm. Tesla does some scary
another
stuff.
thing you mentioned there with the price of the Tesla options being so high, which they are, and it's because of the volatility. Obviously, it makes it hard to take a position and manage your risk properly, because you can't buy enough contracts and they can move so much. It can just be hard. I love the split now because I can trade shares. I couldn't afford to trade shares previously. So that's my preference. But I'm sure you've talked about this before, is doing spreads,
Yep.
Really cut down on your cost and still take advantage of the ticker.
Yep. Vertical spreads. A lot of people call them the poor man's call. If you are in if you're in a position where you're able to get level 3 options trading with your broker, there's actually a video on the channel for those that have not considered this, and it's something to really make sure that you research so that you understand how it works, because this is a complicated multi-leg strategy that we're discussing here. But it does lower your cost of your contract and does enable you to play these really expensive tickers for a lower cost average, and also caps your profits, so you know that if you hit that max profit level, that you should close your position because it's never going to get any better. So I actually see vertical spreads or call spreads as a really useful tool for the beginner, actually, because it does cap your risk. It's still the same type of risk as if you were to just buy a long call, but you can buy a long call for cheaper, and you have a visible price target where your max profit is in front of you, and you know that you will never get a better price than that level. So if you even approach that, then you can just take that profit off the table and call it a win. And in many cases, with these big mega cap tickers, you will frequently see the price hit and exceed those levels if you're playing your options smart. So it's a good strategy to look into, but a very simple description of it is when you buy a call at the money or just slightly out of the money, and then sell a call further out of the money for cheaper. And what that does is if the price goes in your favor and it puts both of those calls in the money, then both calls get exercised, but you keep the difference. So you exercise the call you purchased, the call that you sold gets assigned to you. You exchange the shares directly to the assignee, whoever bought your call, and then you keep the difference in the price between where you purchased your call versus the call you sold. So if you sold a call at 200, you bought a call at 180, and Tesla went all the way past 200, then the person you sold that call to would pay you $200 for your shares that you bought at 180, and you keep that $20 per share difference. That's $2,000.
Yeah, I'll just echo that. My opinion, trading is about risk management. It's the number one thing, and anything you can do to limit your risk and control your risk is going to be beneficial to you in the long term. And like TD just said, having that spread, it helps you fight the greed, right? Because we all know how it is when you're in calls, or puts, whatever, and it's going in your direction. You're in the money. They could always go higher. The profit could always go up. So I deal with this. I'm just speaking for myself. You're fighting that urge to just hold. I should hold it. I should hold it. Most of the time, what I found out the hard way, most of the time when I do that, I don't make as much money, or I give some of it back. I end up losing money on those last ones, which is again a reason why I don't generally hold overnight, unless I'm in very high profit on a position. But
Absolutely.
So you get that risk. It limits your upside, but it limits your downside. And that's the thing with options is people get killed on them, because you just take on more risk than maybe you meant to, or it goes against you too quickly, or you can't trade them after hours and it gaps down or gaps up and you get caught, and then you're like, oh, I might as well hold because now I'm over my risk. So to me, it just makes a lot of sense to do that. So I do trade spreads quite a bit. I also like it to sell. Most people, you're not going to be able to have enough shares to sell covered calls against the SPY, let's say, right? So something I love to do personally in this market is when I see a big resistance level coming, I sell calls above that level. And it's not because I have 1,000 shares of the SPY to sell my calls against. It's because I sell a credit spread, so instead of taking a debit spread, I'm essentially selling a short position. And again, I can manage my risk with that. I know what it's going to be. I know what my upside's going to be. And all of the things that work against you when you're in short-dated calls or short-dated contracts are suddenly your friend, right? Theta's now your friend. So something I think is worth looking into for people if they haven't looked into that before.
That is a very valid strategy, and I do like that strategy as long as you can like really control your risk and make sure that no matter what you have a hedge, so that if you do end up getting a sign that you're not getting killed on the trade. Selling calls is where, especially naked calls, is where people get into trouble. So
well, you're selling a spread in this case, right? So
selling a spread is like I discussed the poor man's call. This would be the poor man's covered call, where you're selling a call just slightly out of the money, and then you buy a call further out of the money to cap your risk. That is also an excellent strategy. I'm loving the discussion, C-Dub. I was just looking at the SPY, though, and I see that we're getting another liquidity hunt happening right here. So
yeah, we did print a new high of the day, 402.93.
Yep.
We'll see. We'll see what happens here. We're coming up on that last half hour. They usually run the algos, usually closer to 4 o'clock in the 3:45 to 3:55 range, but sometimes you get one around 3:30. So yeah, we'll see. Maybe get a quick pop up. Like I said, I'm not expecting it to go above like 405 at the most. I don't think we're going to get that today. That would be a pretty strong move right here. But hey, it's a 2-point move. It could happen.
And part of what I'm actually expecting is that we end up gapping up Friday, though, for that first half of the trading day. Because the way I'm looking at this, yeah, if we do end up closing at the high, I think that we could end up seeing a gap up on Friday morning. We're printing an ascending triangle, a very bullish one right now, and it coincides with a I guess I would consider this to be a bull flag, just based on the shape of it.
Yep, you could call it an ascending wedge, bull flag.
I'm actually really watching Nvidia right here. This looks like it's sitting, that it broke a level of resistance that it had from when? Back on the 14th?
Yeah, that 165 level.
Yeah, this like gap that it's been playing in. I'm looking for it to try and get up into like 168, 170 range maybe. Like this is definitely one that's been on my radar that I've been trying to. I made a little bit on it yesterday. I got out before it retested to 157, so I managed to save that. But if I would have held them, they would. I mean, they just kept going. So I'm looking at this for a re-entry, and I was really concerned about this 165 level. And it looks like we popped it, and we're trying to hold on top of it. So I want to see some volume push off of this level. And I think I'm going to get back into this and ride to the upside around 168, 170, somewhere in between there.
Nice call out. I already closed my short position on Nvidia with a large profit. I took about 2,000 in profit on my trade off of a initial 1,000 risk, so that perfectly hit my 2-to-1 risk to reward ratio, and I saw we were bouncing off the 100 EMA. So I'll wait to see how it reacts to this level, because we had a this evening star off of earnings, and the earnings were terrible. I covered the earnings call, and it was god awful. So I kind of expect Nvidia to see rejection here, but I don't know. The whole semis market is moving to the upside, so it may just be getting some sympathy. Let me go ahead and cover some of the requests from the chat, though. I've got some requests coming back in for AMC. So right now, AMC is on the 5-minute chart is still printing the rest of this flag. I actually really like the look of it. It's still holding up support nicely. On the 30-minute, all of our moving averages are pretty far apart from each other. The 1 hour, we've had multiple crossovers, and on the daily, I'm waiting to see when we're actually going to get the 20 to cross this 50. We're still a little ways away from that. It's probably going to take several days of us trading at these levels for us to get there. The price that I was hoping for AMC to close above was at least $8 on Friday. But we've got some headwinds ahead of us. AMC, in order to keep pushing the upside, really needs to close this day above $8 in order to keep the momentum going. We did get a nice volume pop thanks to that little piece of news from Reuters and Seeking Alpha, pointing out that Amazon was going to be spending $1 billion on their new cinema releases. So Amazon's going to get into the movie business, publishing some new films, and AMC will benefit massively from it because Amazon is promising to show those in theaters ahead of showing it on their platform for Amazon Prime Video. On the short term, AMC is looking very bullish. As I pointed out earlier on in the stream, we do appear to be printing a inverse head and shoulders pattern. You could call this an ascending wedge or a ascending triangle. It's really a choppy pattern. AMC's been putting in lower lows, so this is the first real pop that we've got in AMC recently. We have to wait and see how it responds to this price level at $8, though. It's been suffering rejection after rejection at that level repeatedly over the last several weeks. So we had a pop through it here. We got rejected here. We never made it quite back to that level on Friday last week, and we're getting rejected today. So far, AMC hasn't quite cut the mustard. We're waiting for it to retest $8, and hopefully we can see we're basically seeing another battle for 801 happening. If AMC does close above 801 on Friday, that will put more than 30,000 call options squarely in the money, if I'm remembering correctly. So keep an eye out.
Just to point out, it looks like Webull had some indicators that it called out. The first one was a double bottom. I'm looking at the daily. And then it's calling another one that just popped up yesterday, an engulfing line, which is bullish, and an inside bar, which is bullish.
Yeah, short term, it looks like it has a little more room to me. It did a good job, holding that 50-day, which is right around $7 now. And you could, if you're looking, I'm just looking at the daily here. Mm-hmm. That's a bull flag. Use the 50-day support, and candle today would be a breakout out of that. So that's all good, decent volume. But as you said, it's at a critical area right here around $8. And honestly, if I'm looking at short this, I don't have a position in AMC, so so everybody knows. I see it coming up on that 100-day at 865. That would be the level I'd be looking at. You can see that was a pivot level back in July as well. So you can, even if you go back further, you can see that it's reacted to that level right around 850, 865 a bunch of times. So that would be the level I would be looking for if this momentum were to continue forward. If I was in a short-term trade, I'd be looking to take profit in front of that, because I guarantee you there's going to be short sitting there waiting.
Yep, that is most likely the case. If we do see a bit of a run in AMC over the next couple of weeks, it's going to require some big volume. We got a really nice pop in it today, so that's a good sign for AMC going into next week. If we do end up with the holiday rally playing out, then that will also be very good for AMC, as long as along with the rest of the IWM stocks. Anything that's trading on the Russell will see a nice push to the upside as long as the market is in agreement. As far as technicals go, I'm watching very carefully this volume direction candles indicator. We've had consistent bounces off of this fast moving average line, and as long as we're trading well above it, it's essentially an on balance volume indicator, but just with moving averages and momentum candles based on the strength of the move. So it kind of helps illustrate just how much that volume is assisting the price action. And we're starting to really see that bullish push from volume recently. So we've got our first real push from AMC to the upside. If we do get a continuation bounce here and we crack through that 100 moving average, like C-Dub was calling out, we need to see it hold that level and keep pushing a little bit further. If at any point it does manage to reach the 200 EMA, that is almost certainly where shorts will be looking to hammer this thing back down. So something to be careful of. If AMC can continue to put out good news catalysts in favor of its continued business operations going into the Christmas holiday season and into spring of 2023, then that could be really great for AMC. Biggest thing that's kind of acting as headwind for them, as most of you already know, is just their debt situation. So they got to be bringing their revenue into the company. That's what everybody is waiting to see. So every good earnings report is good news for AMC. The better these are consistently, and they are getting better consistently. New surprises with growing revenue consistently for the last several quarters. As long as they can keep up that momentum, AMC's in great shape to continue moving with the market. Let's go ahead and look over at BBIG. I've got some requests for that one also. And then we'll take a look at Carvana after that. So BBIG is starting to test these lows again. This is what I was kind of what I was expecting from BBIG. It did test this new low here back at 65 cents. So BBIG back in August was knocked down to a low of 67 cents. And I had already said that this double bottom is still intact as long as BBIG doesn't break below. Let me move my paper trading account out of here because it's like really getting in the way right now. So BBIG's lowest low sits right at 67 cents, and it created a new lower low with this last move today down to 66.21 cents. So for BBIG to rebound here would be absolutely huge because that would confirm the spring. In order to actually confirm that move, two things that we need to see. We need to see this bullish divergence complete. So we need to see this new higher low in the RSI get confirmed, and that would confirm this bullish divergence with a lower low in the price action, but a higher low in the RSI. We need to see bullish crossover on the MACD. It needs to rebound here, and then we need to see some volume come into the company. The biggest thing that we're waiting on BBIG is for them to get their earnings reports out. They're behind by 2 earnings quarters, and they really need to get caught up. If they don't, then they're going to stay out of compliance with NASDAQ, and they will get delisted. So that's something that they absolutely cannot allow to happen. As far as I'm aware, the new CEO, Ross Miller of BBIG, is working, basically working overtime to get the company's earnings reports out. But this is going to take some time. I believe that their biggest problem is just how badly Colucci fucked up the books. He really screwed the company over when he started pulling his shenanigans and throwing money across the seas to that Philippine company. I'm trying to remember the name of it. AI Pros. Which after the research that I did, I was able to basically prove that the company doesn't exist. The office is empty. That's in Redwood, California. It's not even occupied. And their entire domain, AIPros.com, it's not in use. The domain is still registered, but there's no infrastructure there. There's no web servers, no mail servers, no nothing. All of it got taken down inexplicably as soon as the BBIG court got started. So as soon as that case went to court in Nevada, suddenly AI Pros disappeared and vanished off the face of the earth. So that's not sus at all, right? So anyway, as far as technicals go for BBIG, very critical that it bounces here. Really needs to recapture this level of support and get back to 80 cents. If it can do that, then that will confirm this double bottom, and we can expect BBIG to move back up to the $1 level as a take profit level. That will put it right in line with the 100 period EMA. And if we see the price touch 100 EMA and hold in this level, basically create a bit of a bull flag in this range, consolidate above $1, then that would be the catalyst for a technical move up to the 200 moving average at $1 at the high side, or 120 at the low side, depending on where we're trading. We'll know a little bit closer to the time when the price actually makes this move, but this is a forecast, not a prediction. We have no idea what the price action will actually look like going into the rest of the month. Another thing to keep in mind also with BBIG, the merger is not going to go forward until they get back into NASDAQ compliance. So that's going to be one of their big priorities, is to get that settled. Without NASDAQ compliance, no merger will get approved. They need to have NASDAQ compliance in order to continue trading on the U.S. securities market. So that has to happen first. As soon as we get those earnings reports released and they are brought up to date, then I have little doubt that the merger will go forward. Vinco's already taking actions to reduce its labor force. They had a lot of employees that they probably did not need. And I remember in speaking with Zash Global Media's CEO, Eric Finman, stating that he was looking to replace the entire social media management team from Zash and grow the social media management team for Vinco. Well, he didn't expressly state that he would be growing the media team from Vinco, but I interpreted his statements to mean that the Zash Global Media team would be kind of taken over by BBIG, and they would manage the social media aspect and try to grow the Lomotive platform. Let me see what else we got here. Hey, we got 137 people watching this stream right now. If you guys are enjoying it, be sure to hit the like button. That really helps out the YouTube algorithm and lets us know that we're doing a good job. And if you're just finding this information generally useful, you want to get more in the future, remember to hit subscribe and hit the bell icon so you get notified when we go live. Let's go take a look at the rest of the market and see what SPX and the SPY are doing. So SPX broke through its SMA. I believe this is the SMA. EMA. All right. So the daily EMA is broken. We did close above. This is exactly where we look like we're going to close above. It's not carved into stone just yet. But as long as we close above 402, then I think the SPY is in good shape to continue its movement going into Friday morning. Just a reminder that tomorrow is a holiday. Happy Thanksgiving, everybody. We'll be watching the market Friday for a half day, and it will be closing at 1 p.m. Eastern time. So just be aware of that. We're looking forward to seeing what the market does at Friday open. My personal expectations is, with the FOMC notes release showing that the Fed kind of got what they wanted from their CPI data release, they were already discussing the possibility of a 50 bips hike, which would be a pullback from their usual 75 points hike that they've done over the last 2 or 3 quarters. And as long as nothing drastic occurs that would basically pull the rug on the entire market, such as, I don't know, like a labor union strike for the railroad, then I see no reason for the market to move to the upside. But on that note, the Smart Railroad Union has decided that they will not take their new job offer, their new contract from the railroad companies. So this is going to lead to a strike going into the first week of December, as early as the 6th. This can put some serious pressure on the market, so be aware that that is going on. It will most likely require Biden and Congress to step in order to give the union what they require in order to continue rail operations. it would be absolutely devastating to the economy if this rail strike were to go forward and cause the and basically cause the entire transportation industry to go to a halt. So if that occurs, just know that the market is going to hate it. Be on the lookout for that. It's being reported on by most of the major media outlets. I have at least one other story from CNN, USA Today, and CNBC covering the Union Pacific Railroad, the possible Union Pacific Railroad strike. And just to be aware, the decider of that is the Smart TD Railroad Union.
Yeah, just to add a little bit to that, with the Fed hike. So right now, I posted that in chat there. Market's pricing in 76% chance of 50 bips, and about 25% chance of 75. I don't think there's any way you get 75. The economic data would have to be so bad. If it's just kind of average or the same, you're just going to get 50. It would have to be probably worse than the September print, which was like an 8 something, right? 8.2, 8.3. I think you'd have to be in that range to get more than 50 in December.
Yeah, point. Either way, you'd have to see it tick up from November. Like in whatever it was, what 7.7 or 7? Was it something like that? Like you'd have to see it go up.
Yeah, 7.7 or 7.6. I saw both numbers at different times.
Right. Yeah, I think you'd have to see like 7.9, 7.8, something like that in order to see it like actually move to the upside.
I think if you got a 7.9, it would just give you the 50. I think it would really take like at least an 8 handle to get more than that. But
yeah,
just my opinion.
Yeah. No, I can see that.
And just to recap the seasonality chart, which we were talking about earlier on in the stream, this seasonality chart dictates that we are just at the cusp of a Santa rally. So late November is when we start to see the market really start to turn around. And we typically do see a big run in the SPY and risk-on sectors going into early December, and sometimes, in certain cases, the extreme end of December for a big Christmas rally. December is by far, on average, one of the most bullish months in the market. And it comes after some seriously bearish months, historically speaking. So there is a possibility that we see the market really push for the, shoot for the stars, as it were. So be on the lookout for that. Generally, being positioned long on the SPY is one way to go about it, but also focusing in on the mega cap tickers, especially the ones that are most oversold, is also an extremely valid strategy. Some ideas for that: you can look at the Qs to see if this sector is going to make any new pushes. So far, the Qs has been extremely weak, so it may be better to look at the semiconductor sector, which seems to be pulling its weight a little bit better. We've seen a big rebound in the SOX ETF. This is the Philadelphia Semiconductor Index. You can also look at SMH, which is the VanEck Semiconductors ETF, which you can see is looking pretty similar to the Philadelphia Semis Index. Another section to keep an eye on is XLY. That's the consumer discretionary sector. This sector I was considering going position short on, but after seeing the market rebound and the latest Fed notes, this inverse head and shoulders looks like that is the trade to look for. So expect at a minimum for XLY to try and make a push back to this 147 level. That is also a possible trade. For specific stocks, things that I'm looking at are FedEx, which has created this huge gap after its last earnings report, which was a massive disappointment, along with further guidance that the company was expecting to draw down its workforce and was expecting some serious inflationary headwinds, especially with the cost of fuel. So that did not look good for them, but it ended up overselling FedEx so badly that as soon as it tested this gap, it ran halfway through it, and after a 50% retracement, is getting ready to challenge that resistance again. So FedEx is looking like an excellent trade. Big shout out to Tempestuous Persephone for being the first one with eyes on this one, all the way back in late October. Let's see. So we
Very
also
nice.
have. Somebody have something?
Oh no, that was just me. I was just saying that was a real nice call there.
Yeah.
I will add, just one thing I want to add to your seasonality chart there. I threw it into the chat too. The only time that doesn't generally play out is during a bear market, which obviously are fairly limited. So just I would take that into consideration. As we said earlier, and I'll just repeat it in case some people weren't there in the beginning, I do think we get the rally this year, but just wanted to throw that data point out there so people have all the information.
Hey, that's much appreciated, C-Dub. Thank you very much. Where did you get this from? Topdowncharts.com? Is that where that's from?
I got this. I just Googled it to get
Just
it.
Googled it?
Okay. Yeah, so I get like live wire markets. It's not a site I use, but I just Googled bear market seasonality because I've seen this chart in multiple places.
Right on. Appreciate that. All right, I'm going to take another quick look at Apple, which I've been watching it closely on the 2-hour. This diamond pattern, which I've been speculating has been forming, it's now been holding up its support for quite a while now. And this bull pennant that it's been trading in is starting to make me think that maybe Apple will go on for another run. So what I'm watching very closely is for Apple to break this 150-250 level. If it can break this this high, then I think that Apple might end up leading the tech sector to push back to 160, possibly up to 165 at the high end of it. Apple, as you've no doubt heard me point out a few times, has created a lot of tops consistently on this megaphone pattern that it's been trading, and it never retested the bottom of this megaphone. I think that we'd need to see something truly disastrous happen to Apple for it to finally give up the ghost and drop all the way down to, below triple digits. But we're at a big inflection point here where if Apple breaks to the upside, it can lead the tech sector and push to retest its highs. But if it breaks down to the downside, then we're definitely coming back down to retest 130. That I have no doubt in my mind. Conditions that kind of give me some inkling that it is going to push to the upside is that the volume has been good, and we're talking about a Christmas rally as the volume candles are moving upward continuously, and we're getting some nice consolidation in the RSI. So there is room for Apple to move very quickly. Another one to take a look at is Meta, which has been pretty badly oversold, but has recently been printing a bull flag. So watching this one, I see it getting ready to break out above its 100 period EMA level at 112.50 would be the price level for it to break. There's one of two possibilities that I see here. Meta either continues on and fills this gap just based on a technical trade, because fundamentally I see Meta as constantly losing money, and now they are drawing down their workforce because they realize that their expenditure was way too high. Or I could see it collapsing even further because faith in Meta and just a general drawdown in social media and advertising revenue is constantly hurting this company's revenues. Hey, Splashy Sam, thanks. I'm glad that your Nvidia short went really well. I ended up taking profit at a $2,000 profit on an initial $1,000 risk, so I made I made a 2-to-1 risk to reward take profit on that one. I ended up getting stopped out on this candle yesterday once it broke back above 155. And I was very happy with that trade. That was excellent for me. I'm now watching to see if Nvidia creates a double top formation and a bearish divergence on the RSI. that would meet all of my conditions for a big short down to the bottom of this descending wedge pattern. I've been watching this one really closely. So we've got this Christmas rally that we're dealing with Nvidia, and it does seem like it's starting to push with the rest of the semis market. The semis market overall is doing quite well, even though Nvidia had really bad earnings. So this is just pure sympathy at this point, in my opinion. Nvidia, all of their money is being poured into cloud-based and data center technology, which a lot of companies are now moving away from it because it's become really expensive. Nvidia also just announced that they're going to be spending an absolute metric truckload of money on quantum technology in a partnership with, I believe it was, I don't want to say the wrong company because they did partner with somebody, but I can't remember who it was. Hybrid classical computing with Microsoft. Okay, it was Microsoft. So Nvidia is partnering with Microsoft to create new quantum computing technology. So that's one of the bullish catalysts, air quote. But my problem with this is that Nvidia is spending so much money so quickly. I feel like they're going to burn it all before they can actually bring it to maturity and start making money off of it. It's kind of like a pet project. The future in quantum computing, in my opinion, is a great pursuit, but is still so expensive and so far-reaching that it's not really a practical use of technology yet. And in this current environment, with the economy drawing down and with Nvidia literally hemorrhaging money while their retail market for their graphics cards is just totally, the demand is evaporated. Plus, all the crypto miners that are now bankrupt are putting all their aftermarket cards up for sale on eBay. So anybody that wants a graphics card in Nvidia can easily get one for a better price than what Nvidia is charging. So the aftermarket for graphics cards is taking away more than half of their revenue. So the way I see it is Nvidia is ultimately going to be another short for me. I'm not going to go long at these levels, even if I see it pushing. What I'm basically waiting for is for Nvidia to, one, touch the top of this descending wedge pattern. Two, I'm waiting for the price to create a higher high and a lower high on the RSI. That would be bearish divergence. And that meets all the conditions for my trading strategy, which says when you see a cross down on the PCO, that's price clouds oscillator, outside of its price cloud, and you see a RSI bearish divergence with a higher high in the price with a lower high in the RSI on the daily chart, that is confirmation for a short to trade it to the downside for between 30 and 90-day swing. And I take that trade as soon as I see the RSI bearish divergence. I don't wait, and I hold that trade with a at a minimum a 3-to-1 risk to reward ratio. But most of the time, it ends up working out to be a 5-to-1 or greater. Hey, King Cabina. I'm not sure why everybody is getting so upset over BBIG. Like, everybody's got to remember that they just got back into control of the company after this massive court case that was draining a whole bunch of their own cash. It was literally corporate sabotage. There's no other way to say it. Like, there were saboteurs inside the company that literally seized control of it. And for what reason, I can't understand. But they're having to recover from that. And you've got Ross Miller, who's an outsider coming in, trying to figure out how he's going to rescue this company and get their earnings out. So we have to wait for the earnings report to come out first. Once the earnings reports come out, then we can see things turn around. Because that means that the merger with Zash Global Media can go forward. But until then, like, you just gotta let it play out, man. Just gotta let it play out. All right. Well, that's enough of Nvidia for right now. We're about ready to close the market, so I'm going to move over back to the SPY. It looks like we are going to come right down to the wire on this close. I'm looking for a close above 402. Ideally, I would have liked to see the market close 402.75 right at the height of the market. But I can be satisfied with this. We're in the last 3 minutes of the market, so usually we'll see a big candlestick here right on the last closing candle. Let's go take this straight down to the 1 minute chart. This is where things get interesting. We got an inverse head and shoulders here on the market on the 1 minute. It's a pretty noisy.
Pull back into close a little bit here.
A little bit of a pullback. All right, we'll see.
That's what I'm starting to see some volume come in on the sell side here.
Mm-hmm.
It certainly doesn't have the juice to go up and break the high, but we'll see. I mean, VWAP's still right there at 41.50. That's probably about where you're going to close.
All right,
would be my guess.
I love having you around, C-Dub, because you've been trading the SPY like nothing but SPY for how long now?
I've been focused on the SPY for the last year or so, almost exclusively.
Almost exclusively?
Well, I shouldn't say exclusively. I trade other stuff too, but the SPY is my primary for sure.
I got 50 seconds. Now is your chance to make your final decisions, everybody. Just a heads up, the market will be closed tomorrow, and it will be closing early on Friday for a half day for Black Friday.
I believe bond markets are closed and banks are closed, so for anybody in a cash account, your trades won't settle.
Quick peek at the overall market. Looks like the market is overall closing green. Nvidia, Tesla, John Deere, Disney, all leading the market. Let's see it.
Nope, let's go. Let's make a liar out of me today.
Hey, you know what?
I'll take whatever I can get. I still got a couple of calls right here, so I guess
right?
a couple cents out of these.
Like it's one of those situations you're happy to be wrong about it.
Yeah.
Look at it go.
We started to see. Yeah, it's getting some volume now on the sell side. We got that. I'm looking at a 3 minute chart, but so the previous candle to the one I'm looking at, you saw that spike in sell volume come in, which was higher than almost as high as the initial buy volume that came in on the FOMC minute reaction, and right with that second candle. So typically when you get that kind of a move up in volume, and that was a red candle, that wasn't a doji or anything like that.
Yeah.
You usually get continuation. It's algorithm selling into the end of the day, and with the holiday too. So hey, that's a good sign right there that it's going to close with that kind of green volume.
That's excellent. I'd love to hear it. All right, we're going to go ahead and count down the SPY. We're down to the last 5 seconds on the market. 5, 4, 3, 2, 1. Ding, ding, ding. And the market closed at 402.39. That's a nice bullish close. I like the look of the charts. So far, SPY looks like it is going to consolidate on this. I'm going to call it a ascending triangle because I see this flat top of resistance right here, but I do see higher lows showing up in the market consistently. So, drawing like so. The anticipated move would be for SPY to retest the 403 level and hopefully break out in order to see the market push to 404, maybe 405 on Friday. It's a bit of a lofty goal, but we got a really nice push of volume today. The FOMC notes came in within expectations. The market was expecting this, so fair warning, it can always price in the expected move and end up seeing some return back to the downside. But so far, the market does look like it's making some healthy movement. I'm going to go ahead and move over to the daily chart, close out with some other analysis on the rest of our market indicators. So far, we got a higher high on the RSI and a higher high on the price action. So no RSI bearish divergence yet. So we're still good for long trades. There's nothing to stop us now. Go ahead and review the overall market heat map. So tech sector leading, risk on, very risk on market. Consumer durables, especially with Tesla moving up 7.7%, looking really good. Retail is starting to come back, and Target actually made a 3.5% recovery today. So good look for Target. Disney moved up 2.75%. Overall, I would say the market was very risk on. Everybody was looking forward to the Fed FOMC note release. And with tech sector moving up like this, I feel confident going long elsewhere in the market. The energy sector is down big time, so that's actually I have to wonder if the railroad strike may have had something to do with this. The energy sector XLE index has been really disappointing the last several days. Kind of just chopping to the side lately, but I noticed this head and shoulders pattern starting to form up here. And if XLE drops below $90 price level, that could spell some pretty serious pain for all of the oil producers in the country. So I'll be really closely watching XLE to see what the market sector decides to do. This is precisely where we topped last time. So if we end up seeing the market top here again and it crosses down, I'm going to be swinging a short trade from 90 all the way back down to around 80. I'll set my take profit on that level for I'll probably go about 30 days out on that trade. And we'll see what we can get out of it. For those that are unfamiliar with my trading strategy, one of my biggest strategies is I always look for a bearish crossover on MACD followed by a RSI bearish divergence. We've had 2 of them now. 1, 2 higher highs on the price target with 2 lower highs on the RSI. That counts as bearish divergence. And now we're starting to see volume direction candles curl over to the downside towards its moving average. So that tells me that the XLE, that's the energy sector, is broadly topping. So I'm going to be looking for short opportunities on tickers like Exxon and Chevron. So Exxon is also meeting all of my conditions. We got that bearish crossover with bearish divergence on the RSI, higher highs on the price, lower highs on RSI, bearish crossover, and volume direction candles coming down. This by far has been my best strategy. I've been getting really good performance on 30 to 60 day swings with this strategy, and it's been a lot more consistent. It's got way fewer false signals. This one's been performing very well for me. I'm not ready to take the trade just yet because there is the potential for one more higher high tomorrow, especially since FOMC was within expectations. But I am kind of expecting for the energy sector to start pulling back now. We'll take a look at Chevron Corporation. This is another oil producer in the market. They're also forming the exact same technical patterns that I've been watching for. So crossover right here, pull back on the RSI, higher highs on the price. That meets all of my conditions and confluences to take a short position on this one. I'm going to go for a 50% retracement pullback. So that would place me at, it might be a little bit aggressive, so I'm going to go to 170 on Chevron. So that's where I'll set my trade levels. If I see another push on Friday morning, then that will be my signal to go short. So Chevron, Exxon, liking both of these for some pullback. Let me take a look at the other sectors here. Take a look at the weekly. Yeah, so far the industrials are still the weekly performers. They're even outperforming most of the tech sectors. So Dow Jones has been pushing for sure. E&G, Coca-Cola, PepsiCo, all those consumer staples are really, really pushing. Let's go take a look at some of the other plays that Hell's Trading Floor has been looking at. I'll be releasing a video on a very special squeeze play on Friday. This is one that we have been watching really carefully, doing some analysis on. Hell's Trading Floor is going to get first dibs on access to this ticker. So I'm not going to be discussing it here just yet, but we've been talking about a series of potential squeeze plays that are starting to look better and better each time we go back and look at them. So I'll be looking forward to releasing that on Friday. For those in the Demon's Floor, you already know what it is. Let's take a look at some of the other plays that we have. Cosm, that's Cosmos Holdings. We got our big pullback on Cosmos. It saw a really excellent drive to the upside all the way up to 66 cents. We've now hit the 62% retracement level on the fib, and it's actually closed below that level. If I go all the way back to the base of the original move, we're now testing the 62%, has not broken it. So I would tend to go with this fib retracement level. If Cosmos ends up holding this level and we see the moving averages come up with it on the 2-hour, you can also look at it on the daily. We've got several crossovers happening on the daily, which is a really good sign. If we see the 20 cross the 50 on the daily, then and the price hasn't declined any further, then I will probably take that as a sign the market is still in agreement with this price. But if you're out of it, stay out for now. Watch it closely. If you're already in, then I would have hoped that you took profit once we started coming back down earlier today. We had a crazy move this morning. So if you were already in it when Chef called it out, big shout out to Chef Pew Pew, then profit taking should have happened at least no lower than 50 cents. But we got a really nice run out of this one. So congratulations to everybody who had this play in their watch list and took advantage.
Oh, it was also Savvy. Savvy's the one who brought it.
Savvy. I'm sorry. Savvy, man. Savvy's been throwing out all kinds of runner tickers lately. I'm sorry, Chef.
I'd like. No, it's cool, man. I'd love to take credit for it, but he called it out, and I looked at it, and then I blew it up. But either way, it was Savvy's call out. I just want to make that clear.
Right on. Well, Savvy called it out. Props go to Savvy. Thank you guys for calling out this ticker. That was an excellent setup. Let's go take a look at, let's see, what else do we have? We have anything else in the watch list that was making big moves? I already discussed Nvidia. We closed that short position in profit for a nice big 2K profit. Tesla kind of rug pulled us, and I gave back some money to the market, sacrifice to the gods. If I see some pullback in Tesla and it starts to range in this area between 180, if it holds the 180 support, then I'll consider going long for the Santa rally. But I'm staying out of it for right now. It wasn't a big loss for me. I always hedge my bets, make sure that I'm respecting my risk. So always keep that in mind when you're playing these big cap tickers. That way you're never in a position where you lose more than you're willing to. Johnson & Johnson trade is going quite well, actually. I talked about this one as a defensive sector stock. Still in this trade. Johnson & Johnson is still pushing up 176, and I'm kind of expecting it to retest the top of this channel. Up around 180 is my, it's actually 181.20 is my take profit level. And it's held up so far after its dividend record date. So we'll see how Johnson & Johnson holds up, but it's looking really good. If as long as the market doesn't change its mind in any way, I think that we're all good to keep on moving. I see some requests for BRQS. It's been a long time since we talked about that ticker. The BRQS. To say that it is coming back, I think would be a little bit not accurate. It's at a market all-time low. So I don't think it's coming back yet. This is an IoT technology sector stock. Definitely a growth stock. Definitely a penny stock. They well, the market after they reverse split decided that this one just wasn't worth even that. So I think that now after their second deficiency notice, BRQS is probably not the play. Their net income is still way below expectations, and they've not been releasing earnings consistently. So I would say no. I don't like the look of this one. It was a great play once upon a time when BRQS had set itself up, and we saw some volatility coming into it. The short exempts were really great. That was a good opportunity. We don't have those conditions anymore. So just because something is hitting all-time lows doesn't mean that it's something to pour your money into, especially with as being so heavily shorted. Hey, William Price. Okay, I will take a look at BNTX. I'm going to be closing the stream in 3 minutes, so this is going to be the last one. Okay, I see it ranging. It's got a gap here at 185, and it has a clear triple bottom right here, and we're starting to see the moving averages consolidate right here on the 200 EMA. That is a good look for it. I like the strength of it. It's holding up the support very nicely. Very strong support. I like that. That's a perfect level of support at 120. It's a little bit higher up. I would kind of expect a little bit of pullback in this one. What was their last earnings like? Nice surprise. BioNTech is a good one. So Pfizer and BioNTech are kind of like, they're joined together at the hip. They're basically the same company, although they still trade separate tickers. Pfizer and BioNTech are both excellent defensive sector stocks. In general, I would say that Pfizer is the performer of the two, but Pfizer did very well coming out of the COVID pandemic, especially with their performing vaccine. Did very well. Pfizer definitely outperformed BioNTech, but BioNTech has a lot of the growth and development, medical equipment and stuff that Pfizer really pushes. So this partnership between these two companies can be a very lucrative defensive play. If you're still short on the market, keeping your equity in tickers like BioNTech and Pfizer is a smart move. Because right now, healthcare and pharmaceuticals is relatively stable, more or less. The downside risk to this one is if, basically the same as everybody else, inflation woes and cost of doing business rising and having to cut employees in order to make up the shortfall on the balance sheets. That's one of the biggest risks to these companies, which if your goal in the market is to just lose as little as possible, I would view Pfizer and BioNTech as great defensive sector stocks to look at. Hey, KLDG, I have not gone over MMAT, and I just promised that was going to be the last ticker that I covered. So I'm going to have to say I'll give you 5 seconds of TA. It looks like it's creating its step-up pattern with ascending higher lows. It needs to hold this 190 level this week in order for it to make another move to the upside. So that is my thoughts. But the volume direction candles, the MACD look really good, but the MACD's really spread far out. So there can be a pullback at any time. So just be very careful. Okay, guys. Thank you guys so much for tuning into the stream. I really appreciate having every one of you here. If you guys enjoyed the stream, I would really appreciate it if you would hit the like button on your way out. Subscribe to the channel if you want to join in for more streams and other market news. And hit the bell icon so that you get notified. Also, if you aren't already a member of Hell's Trading Floor, always appreciate it if you would consider joining us. We've got a really great trading community with some excellent skilled traders, always focused on market education and trying to teach people more profitable, more consistent winning strategies. If that sounds interesting to you, then please consider joining us by heading to our website at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Hell's Trading Floor. Links in the description of the video. That's going to be it from me, guys. Thank you so much for watching, and I look forward to seeing you next time. But until then, have a hell of a time in the markets.